conference, What Comes Next? The Economic and Budgetary Consequences of the Bailout, which is sponsored by the Committee for a Responsible Federal Budget and the New America Foundation. I'm the president of the Committee for a Responsible Federal Budget, and I run the Fiscal Policy Program at the New America Foundation. And thank you to our C-SPAN viewers who are watching the program live with us today. The committee has been running a special project called U.S. Budget Watch in partnership with the Pew Charitable Trust to follow the policies of the presidential campaigns and their fiscal impacts. The project can be found at usbudgetwatch.org, and I direct your attention to our fiscal voter guide called Promises, Promises. Certainly, we're living in turbulent times. Rarely in recent history has there been a situation with such an impact on the economy that has been unfolding at such a rapid pace. It seems to me, at least, that I spend every day just trying to follow all the details of what's going on, formulating kind of opinions about what we should be doing, only to wake up the next morning to find that the world has completely changed. And of course, it's scary. It's scary to not know what's going to come next. It's scary for individuals not to understand how this affects them economically. And it's scary for us not to know what comes next on the for the global economy. So today we bring you this important policy forum focusing on the likely effects of the turbulence in the economy, the recent stabilization package, and any further actions that may be necessary going forward. I'm so pleased that we've been able to bring together really the leading experts on both the financial, economic, and budgetary impacts of what's going on in the world economy today to join us for this panel discussion. We have two panels, and our first will focus on the economic and financial issues involved in the current situation. We're joined by Martin Bailey, the former chairman of the Council of Economic Advisors, currently senior fellow at the Brookings Institution, Dean Baker, co-director of the Center of Economic and Policy Research, Mark Zandi, chief economist, moody'seconomy.com, Rob Duggar, Tudor Investment Corporation, and Tim Adams, former undersecretary for international affairs at the U.S. Treasury and managing director of the Lindsay Group. What I've asked from our panelists is that each of them talk for about 5 minutes today to give us an overview of the situation that they think we're facing, where we might be headed, what they think we should be doing, what we're likely to see next, to leave us plenty of time to have discussion among the panelists and a Q&A, which involves everybody here in the audience. So once again, thank you so much for joining us for what I'm sure is going to be a fascinating panel and a very uncertain time. And I'm going to turn it over to Martin Bailey.
Excuse me, thank you. 5 minutes is pretty quick to give an overview, so I guess I'll talk fast or say as much as I can in the time. First of all, how did we get here? We got here because house prices went way out of line with their reasonable fundamentals or with their historical trends, which led to a misestimate of the risks involved in investing in real estate, either directly as households decided to purchase homes, or in terms of investors, financial investors holding asset-backed, mortgage-backed securities of different kinds. That bubble in the housing prices was triggered in part by easy, or should I say over-easy, availability of funds. We had low interest rates from the Fed. We had a lot of money coming in from around the world that made interest rates, longer-term interest rates, low in the United States. So we had this belief that housing was a great investment and the securities associated with it were a great investment, and we had lots of money to go down that road. There are problems in the originate to distribute model, which basically means that the folks that were issuing these initial mortgages typically did not have a stake in how they turned out, nor did some of the brokers that were helping people get loans. So there was a lack of skin in the game, if you want to put it in those terms, so that those people originating a lot of those loans did not necessarily bear the consequences when the loans defaulted. Some of that lack of skin in the game moved down the line, as well as the financial institutions that were issuing some of these very complicated securities also passed them off down the line and were not really accountable when they defaulted. So the lack of transparency in those securities was also a major contributing factor. The rating agencies failed to do their job. Arguably, they were compromised because they were advising on these securities as well as rating the securities, not necessarily the same person, but within the same company, and I think that created a kind of moral hazard problem. In any case, they certainly did not rate these securities on the basis of the real underlying risks. I think there was a lack of effective regulation. There were lots of regulators, rooms full of regulators at some of the banks, but they were not doing their job. I think that at some point somebody should have said to the regulators, banged on the table and said, we know this bad mortgage lending practices are happening, and we've got to do something to stop it. And that is something that could have at least mitigated this crisis, if not stopped it altogether. What is the forecast for the economy in the light of all this? I think we are in a recession. I think GDP has been declining since mid-year, June, July. We might get a small positive in the third quarter, but that's because of the jump up in the second quarter. Effectively, the economy is now declining. I think we will certainly get a substantial negative, maybe -2 in the fourth quarter, and probably a negative number in the first quarter of 2009. I think the optimistic view is that the economy will bounce back after that, although I think it will remain sluggish even under an optimistic view, because it will take a while before we work through this financial crisis. But we are now, as well as seeing the sort of traditional pattern in a recession where consumers get concerned about their jobs and their income and they cut back on consumption. I think we're also, this is now being compounded by lack of availability of credit, which is affecting businesses and households as well. Obviously, construction has been intimately tied to this. The collapse of house prices has led to a collapse in construction. That's a big negative. The bright spot has been exports. The dollar declined, actually going back up a little paradoxically right now, but the dollar is certainly lower than it was going back to 2002. That's helped exports strengthen and has softened imports together with the weak economy. But since we're now seeing this slowdown affecting not just the US but the rest of the world, I think it remains a question whether exports can show up. I think there's a distinct probability, maybe in the 40% range, although these probabilities, I'm not sure how much they mean, but about a 40% probability we could go into a more severe recession than that. If this bailout package doesn't work, I think we almost certainly will go into a pretty severe recession, but we might, even if it does in some sense work, because at this point the dynamics are pretty negative. Will the bailout package work? I think we've been learning, I've been learning, including from Rob Duggar, my colleague on the panel here, about what to do here. I had sort of reluctantly supported the package on the grounds that we had to do something fairly drastic, and this was the game in town, and that buying troubled assets from the banks was the best thing that was available. It now appears that the Treasury does have the authority to buy equity in financial institutions and use that as a direct way of recapitalizing the banks, and I think that is definitely what they should do. The problem right now is that the banks don't have enough capital. Some of them have been able to raise capital, but others are finding it difficult to go into the market and raise capital. When they go out and raise a lot of capital, that sort of signals that maybe they're in trouble, so there's a sort of negative dynamic there. I think it would be much better for the Treasury to buy non-voting equity. I don't think we want to nationalize the entire financial system, although some countries have done that. I think we need to have the government injecting capital into the banks to be disposed of when conditions turn around, and that's the right way to do it. So I hope Treasury does that. That would raise the chances of this package working. In the longer term, we need a new regulatory regime. We should not go back to tight regulation where the government micromanages the financial sector. The financial sector has been a source of strength in the US economy and can be again, but clearly we need more transparency in financial markets. We need more effective regulation. We need much more focus on systemic risk. That's to say the interconnections among different financial institutions, so that if one goes down, We're aware of the risks that that poses for other institutions. And we need more focus on more capital. Obviously, that's what I mentioned already, but we also need to focus on balance sheets, because financial institutions, by their very nature, are going to be leveraged, so they're never going to have enough capital to guard against the worst possible crisis. We need to have some regulation or some supervision, at least, of balance sheets so that we avoid a repetition of this crisis. Thank you.
Thank you so much. Dean Baker.
Thank you. First, I want to congratulate Maya on quite a job in putting this together. She called me last week, I forget, Wednesday or Thursday, and said, well, who would be good on a panel? And I gave her a list of people. I thought, well, these would be great people, but, you know, bad chance of getting them, and she got most of them, so I'm very impressed.
I'm glad we're on your list.
On my list. I hope I was on your list. Of course. Anyhow,
did you just take credit for making this?
I played a minor role. Okay, first off, I just want to say I appreciate Martin's comments. I don't have to say as much because he said many of the things I would have said, and I actually agree with him on much of it. One of the points I get a big kick out of, some of you may recall back in 2005 when they had the annual retreat of central bankers at Jackson Hole. The 2005 session was devoted to a Greenspan retrospective, and I remember one of the papers was raising the issue, was Alan Greenspan the greatest central banker of all time? I guess if they were to do another Greenspan retrospective, it might be more the worst central banker of all time. I think there's a very different view of his performance based on what we've seen the last, certainly last few weeks, but really the last year. I'll just say a couple comments about the bailout, then a couple of things about where I think the economy is going, not hugely different from what Martin said, and then a couple points about policy going forward. First off, in terms of the bailout, again, I agree very much with Martin. I think just about every economist I've talked to that the correct way, the efficient way to do a bailout would have been a direct injection of capital. That's the problem. The banks need capital. We, instead of going this very indirect route of, in effect, paying too much for bad assets. That's a way of giving them capital, but we get all these bad assets we don't really want, and we waste a lot of money in the process. And again, you know, Martin's exactly right, is my own reading, that the Treasury has the authority, you know, given the bill, it gives them very wide authority to actually go the route of a direct injection of capital. So this will be a question, does this administration do that? And if they don't do that, will there be funds left in that $700 billion pool for the administration that takes office January 21st? I think that's definitely the better way to go. Having said that, is this better than nothing? You know, my view, I was one of the bailout opponents. I always said it was better than nothing, but my concern was, did this foreclose other options? If you spend $700 billion, you're going to get something for it. You know, but the question is, are you foreclosing other options? And that was why, you know, I was against it, although I do have to say at the end of the day, I think it would have been a very, very courageous member of Congress who would have voted for that package, sending it down, given what subsequently happened in financial markets. I'd hate to be blamed for that, and they would be. Needless to say, the people who voted for it and it passed are not blamed, but that's one of the asymmetries of policy in the United States. The last point I'll just say about the bailout, that again, I feel, I'll confess my ignorance, I did not realize until just a couple days ago that the Fed had the authority to directly lend to non-financial institutions, which to my mind would have been a huge game changer, because if we really had our backs against the wall, you know, we were worried, I mean, we do have our backs against the wall, about a shutdown of the economic system. If the Fed had the authority, well, the Fed does have the authority to do what they're now doing, directly buying commercial paper from non-financial institutions, that would have relieved much of the immediate stress. So I wish that had been in the debate when we were talking about the bailout. Going forward, I am a relative optimist. I mean, I think that, you know, we will get through this immediate crisis, you know, so it's not to say that things will be easy here, but we will get through this immediate crisis. I think at the end of the day, you know, the Fed and Treasury have enough duct tape to keep things going, and, you know, so far that has been the case. We'll see if that continues to be the case. Now, having said that, I don't have an optimistic picture about the economy. Again, following Martin, the main problem here is the collapse of the housing bubble. We've lost on the order of $4 to $5 trillion in housing equity over the last couple of years, and my expectation is we're going to lose another $3 to $4 trillion. You don't lose $8 trillion in housing equity and then go on smiling the next day. What's happened thus far, the main impact of that has been a big fall off in the residential sector, residential construction sector. It's gone from about 6% GDP to about 3%. That's been the main source of drag on the economy, and that's been largely counteracted, as Martin said, by, you know, the foreign sector. We've had big improvement in net exports. Also, another sort of star in the economy has been the non-residential construction. There was kind of a boom in non-residential construction, '06, '07. So that did help support the economy, keep it from falling further. But we haven't seen the biggest impact of this loss of equity. That's going to be the fall in consumption. We all know about the zero savings rate or near zero savings rate. That was driven, first we had a fall in savings rate in the 90s because of the stock bubble, further fall this decade because of the housing bubble. Now that that equity has disappeared, people don't have that wealth to spend against. They can't borrow against it. They realize they're approaching retirement age. They have zero equity in their home. We've done analysis of that. It's scary how many people in their 50s have zero equity in their home. And they don't have a big 401k either, by the way, even before the market crashed. So people are going to start saving more. So that's, on the one hand, something that's good and has to happen. On the other hand, that's going to be a very big drag on the economy. And I should point out that we've had a lot of really bad numbers on the economy recently that's gotten almost no attention because of the financial crisis. So, the industrial production, if you look at the manufacturing component of industrial production, the Fed's index that came out for August, it fell by 1%. That's a really bad number. But that got almost no attention because I forget which bank was failing. So, there have been other numbers, auto sales, again, they were down 27% year over year. That's a pretty bad number. But again, we had a lot of other things to talk about at the time. So, this got got buried. UI claims, unemployment insurance claims, have been near their peaks following September 11th. So again, these are numbers that ordinarily would be very, very frightening, very serious cause for concern, but have really been shunted to the background because of the severe financial stress that we're seeing right now. The long and short of that is that I think we are seeing, the economy going into a much, much steeper downturn than we had, say, through the first half of the year. So we're losing jobs at the rate of 80,000 a month, January to August. I think that's likely to accelerate in the months ahead. The unemployment rate, I'll be very surprised if we aren't looking at an unemployment rate of over 7% by early next year, and quite possibly getting over 8 somewhere over the course of the year. So that's not a very good picture. Now, I worry that the debate about the stimulus, the bailout, actually made things much worse. I was really shocked and frankly appalled that President Bush was talking about the Great Depression, and we had this little flurry of Great Depression talk. I mean, I've been the big pessimist here. I've been going around for the last, 5 or 6 years talking about this housing bubble. It's going to crash. It's going to be really bad news, jeopardize the financial system. Now I'm the big optimist. We are not going to have the Great Depression. I mean, that would take a lot of really bad policy over a prolonged period of time. So this talk of having the Great Depression, I think it was really wrong-headed, and what scares me more about it is that it scared everyone else. I was saying a moment ago that we have to have this cutback in consumption, people have to save. I'd like to see that over a year and a half, 2 years, 2.5 years. I don't want to see it over 2 weeks, and I'm worried we might get it over 2 weeks. So that will be a very, very serious problem. So we do have to shift from consumption to other categories of demand. We can't do that overnight. Now, we are going to do it. How do we respond to that? Well, to my mind, step one, the immediate response is stimulus. We're going to have to spend lots of money, and I'll put numbers on lots of money, 300 to 400 billion, because that's the sort of fall off we're going to see in consumption. Okay, and there's nothing else to pick it up. We're not going to see it come from investment. There's no other sector to pick it up. Now, over the longer term, we will have to improve our trade deficit, and that's only going to be done by getting the dollar down. We've been going the wrong way lately. Okay, so over a longer term, we are going to have to see the dollar down. If someone else has a remedy for improving the trade deficit other than getting the dollar down, I'd love to hear it, but I can't imagine what it would be. So over a longer term, eventually we're going to have to replace this extraordinary consumption spending of the last 5, 6, 8 years with increased net exports. The only way we do that is get the dollar down, and also obviously the other, our trading partners are going to have to get back on their feet to improve our trade balance. The last point I'll make is that one of the things I was very happy to see come out of the debate on the bailout was a discussion on financial transactions tax. To my mind, this is great policy. We do need more tax revenue, and you could have a very modest financial transactions tax that could easily raise in excess of $100 billion a year. This isn't crazy. England's been doing this. They've had a financial transaction tax of 0.25% on stock trades going back, I don't know how long, probably 60, 70, 80 years. If you had a tax of that magnitude on stock trades, it'd have almost no impact if people are looking to hold for the long term. Same thing with something, somewhere in the order of 0.02% on trades and futures and options. Again, someone looking to hedge jet fuel or their wheat crop, no one's going to like to pay a tax, but no one is going to hedge their jet fuel is going to decide not to do it because they have to pay a tax of 0.02%. That's a joke. So this is a way to hit speculation. You're not going to outlaw it. We can't outlaw it, but we can make some money off of it. And I was glad to see that enter the debate, and I hope that it comes back and gets considered more seriously in the next session. So I'll stop there.
Thanks very much, Dean. Mark?
Thanks, Maya. I want to thank you for the opportunity to be here today, for all the good work that you're doing. And I am an employee of the Moody's organization, but none of this is my fault.
Feeling a little defensive, are you?
I sold my company to Moody's 3 years ago, and they were not using my house price forecast until now.
Oh, now they do.
So we won't have a problem going forward. We won't have a mortgage market. But I'd like to make 6 points. First 3 are rather dark negative points, and then I'm going to end on 3 positive points of each note. The first point is that the financial panic of the past month, I think, ensures a global recession. The U.S., European, Canadian, Japanese economies are in recession. They account for half the global economy. And emerging economies are weakening very rapidly. China, Russia are slowing quickly. In the U.S., the job losses to date have totaled 750,000, and I think we'll experience another 750,000 in job losses through the summer of 2009. So 1.5 million in total. And that means that the unemployment rate, which was at a low of 4.4% back in March of 2007 and is 6.1% today, will probably peak somewhere between 7.5% and 8% by late 2009. For context, the 80-82 recession, which was the worst recession in the post-World War II period, unemployment got over 10%. But it is important to realize that the underlying rate of unemployment, the full unemployment rate, is probably a point lower today than it was in the early 1980s. So just to give you context. So point 1, I think it's clear we'll be in a global recession into next summer. Point 2, the principal links between what's happening in the financial system and the economy are clear. It's a lack of credit, it's the cost of capital, it's the body blow to confidence, to consumer confidence and to business confidence. And I do think what's very important, indeed Dean made a point of this, is the negative wealth effects. I think everyone now realizes, except for my friend to the right, that we are all worth less, and because he owns bonds. So that's right. And we're going to be worth less for a long time to come. And with that realization, I think the negative wealth effects will be much more potent. If you look at the Fed's data, it says we're down $6 trillion from the peak in terms of household wealth. I think it depends on the time of day, exactly how far down we are. But somewhere between 6 and 7 trillion. The rule of thumb is for every dollar loss in net worth, you lose 5 cents in consumer spending over a 2-year period. I think that's pretty conservative, but let's just use it. So that, if you just do the arithmetic, suggests that the wealth effect by itself will subtract about a percentage point from GDP growth over the coming year, so quite significant. And I think it's that negative wealth effect that will make this recession deeper and feel and last longer than most of the other post-World War II recessions we've experienced. Third point, the cumulative budget deficit as a result of all of this, I think, will be about $500 billion larger for the next president. So when you look at the deficits over the next 4 fiscal years and compare it to what it would have been prior to this financial panic, I think it'll total about $500 billion. Of that, roughly half is the direct cost of all the various programs that are being implemented. Say $250 billion. That's roughly the amount we spent on the savings and loan crisis in today's dollars, including interest. The other half of the $500 billion is the impact of the weak economy on tax revenue and on spending. So about $500 billion over the 4-year period. So that makes life a lot more difficult, certainly for the next president. So you're thoroughly depressed? Those are the 3 negative points. 3 positive points. I actually believe that the policy response to date is going to work, and it's going to work relatively soon in terms of what it means for the financial system. It's been unprecedented in terms of its magnitude, its scope, its creativity. I'll just name a few things that I think are extraordinarily important. The Fed's ability to pay interest on reserves is very important. They can now expand liquidity without limit, and I think they will do that shortly to unlock the interbank lending market. As Dean pointed out, they've now set up a vehicle to buy commercial paper directly from issuers. I think that's going to go a long way to helping the CP market, which is so key to the well-functioning of our economy. And of course, the coordinated rate cuts today, I think, are also very important in that they are coordinated, and I'm sure we'll get more rate cuts as we go forward. The funds rate will fall to its low 1% in the not-too-distant future. I think the TARP plan, the actual reverse auction idea, is a very elegant one, and I think it will work. I think the idea is simply price discovery. If you have price discovery, then you know which institutions need capital, which don't, and how much, and that by itself will bring in private capital. And we're starting to get a sense of that in the marketplace already. It's not about adding capital to the banking system directly. It's about providing clarity with respect to how much capital, if any, the banking system needs and who needs it. And with that clarity, we'll get more capital coming in. So I think that's actually a very elegant approach to this that hopefully forestalls the need to take direct equity investments in the banking system, which I think is ultimately unhealthy for us to do. Fifth, I think the write-downs that the banking and financial system broadly have taken are now approaching $650 billion. Most of that has been on residential mortgage assets, loans, and securities. That is consistent with at least a 30% peak-to-trough decline in housing values. We're down now about 20%, so a 10% decline. It's also consistent with about 6.5 million loans going through the entire foreclosure process through foreclosure sale, and the mortgage owner losing half the mortgage balance in the foreclosure sale. That is very significant. So in my view, it's very possible that once we get the prices out of the reverse auction process, it will become evident that the banking system, financial system has actually marked down appropriately, and it won't need, there will be institutions that need capital, but other institutions that don't. It'll be capital accretive. And so on net, this may turn out much better than we think. And finally, another very important positive is that the wrongs in the housing market are being righted. The decline in housing values to date are restoring housing affordability in terms of incomes and increasingly in terms of rents. In markets where that has occurred, Boston, to some degree Chicago, Denver, Orange County, California, we are seeing price stability. It's a necessary condition for price stability, and if we get another 10% decline in housing values, nationwide housing affordability will have been restored, and I think that'll be key to stability sometime next summer, early fall. Secondly, in terms of the wrongs that are being righted, inventories have clearly peaked. Housing construction is about 1 million, in terms of single multifamily manufactured, is about 1 million a year. Underlying housing demand is about 1.5 million. At this pace, we'll work off the unwanted inventories in a couple of years. That's a necessary condition for price growth, and I think that probably occurs sometime in 2010. And nationalization of the nation's mortgage market, while I think it had many unintended consequences, which we're seeing today, one of the benefits, obviously, is that the mortgage market is now insulated from the vagaries of what's going on in the financial system, which is a very positive thing. And I think we're now at the low point with respect to the availability of residential mortgage credit, and it will become more available going forward. So in my view, I think the economy's problems will remain with us well into '09, but the problems in the financial system, I think we're much closer to the end of that than the beginning.
Great. The effort to end on a high note is appreciated, so we don't get too glum all morning. Thank you.
Well, catch me when the stocks are down.
Yeah. I've made everyone turn off their BlackBerry, so who knows what's going on in the real world right now. Rob.
Amaya, thank you for assembling this pretty diverse panel, remarkable actually, and you've gotten a lot of different views. I will agree with everything the panelists have said so far, but as you hear my comments, you'll realize I do represent a different perspective. I'm Rob Duggar. I'm a partner in a global investment company. Last 2 weeks I spent as a group of people who had a different view of what's going on in the economy and worked extremely hard to make the rescue bill something different than was introduced. significantly different. We've focused specifically on enabling the Treasury Rescue Vehicle, the TARP, to engage in direct equity infusions in banks. We succeeded in that, and I think actually the first action the TARP will pursue will be an equity infusion in a bank. Let me explain to you why we took the view we did. I'm going to go through 6 points. The first one is the current account recycling and the need to restore foreign investor confidence. The second point is the impact of energy and food prices on the business plans of businesses and households longer term. The third is the very fragile condition of household finances. The fourth is what we call the lines crossing problem. The fifth is the civil transition. And the sixth, I will provide a time frame and guideposts to look forward to know whether we've passed through the worst and are on the way to recovery financially. The central idea is that housing is not the problem. Housing is a symptom of the problem. The United States has depended for many, many years on significant inflows of savings from the rest of the world. Recently, we've needed $2 billion a business day in order to keep the wheels rolling in our economy. Housing is just the most interest rate sensitive, the most credit sensitive sector. So when the supply of savings into the U.S. economy was cut off, like the bow of a ship, housing was hit first. But because that inflow of savings has never been restored, it will eventually affect every compartment of our ship. We were selling private assets to the rest of the world at a $750 billion rate in the first half of 2007. We were in 2005, 2006, 2007 as a country packaging all our credit sausage and wrapping it up in credit default swaps and AAA guarantees to make our sausage look to the rest of the world like filet mignon. In the summer of 2007, they opened up the package and didn't find filet mignon. They found our sausage and the subprime in it. They basically saw some mouse hairs and other things they didn't like. They stopped buying. The chart of foreign purchases of U.S. private assets went from 750 billion, it collapsed to about 200 billion in the space of about 90 days. That was the cutoff to the private sector of foreign savings into the United States, the so-called current account deficit that we run. Now the only thing that foreigners are buying is U.S. government debt. So what have we had to do over the past year? We've had to turn our government into a bank. Our government bank goes out and borrows savings from the rest of the world, and it tries desperately to push it into the U.S. economy. It did it with a $160 billion stimulus package. And now it's trying to do it via the Fed rescues of various institutions. But because the problem was never actually housing, it was the excessive dependence or inability of the United States to finance itself in every sector. Credit cards, autos, leverage buyouts, and housing. All of these sectors are cut off. We have to provide credit to all of these sectors, one way or another. Hence, it was extremely important in this last rescue bill to create a capability for the government, Treasury, TARP, to be able to inject capital into banks and other financial institutions in every community, wherever they are, so that you're supporting the towns and cities and counties and states that are affected in every dimension by the cutoff of credit from abroad. Now, so that, you ask, the current account surplus recycling collapsed. That's when it happened in mid-2007. When did it start? When did the United States begin to become dependent on foreign savings? The lines actually crossed on that in 1985. So the problem is at least 20 years old. But they crossed then. What were they doing before that? They were steadily moving towards crossing. We were drawing down our national savings from decades before that. We had a consumption-led growth strategy, a debt-financed consumption-led growth strategy which began in the 1950s. That's what we've been operating on. That strategy has exhausted itself, and everyone who depended on it, the rest of the world, and including ourselves, now have to face a significant change in national and societal priorities. Okay, that's point number one. Point number two, energy and food. The rest of the world is developing. There are billions of people who want to live like middle-class Americans. It happens that we use twice the amount of energy per capita as the rest of the world, in the industrialized world, and 10 or 20 times what they do in the emerging world. Our economy is profoundly energy inefficient. That means that there are thousands and thousands of office buildings and apartment buildings and commercial buildings and warehouses and so of all kinds that are energy inefficient. They are obsolete. And companies now don't have the capacity to get the credit to refurbish them. So we're seeing a very large, quick obsolescence of capital, commercial capital, across the country. Second, energy and food prices have affected the long-term living plans of millions of households. They had budgets based on $30 oil and $1.20 milk. Those are all history. Third, fragile for household finances. I'm indebted to this gentleman and his colleagues at the Lindsay Group for as clear a presentation of the condition of households in the United States as any as I've seen. 50% of American households on average in the last good year, which was 2006, had 82% of their assets leveraged. That is, they had a mortgage and they had a car loan mainly, and that constituted total assets were, let's say, $125,000. Well, their mortgage and their car loans totaled 90-something, 100-something. With the drop in car values, the car loan is, they're upside down on the car, and any other durable goods that they borrowed money on, and with the drop in home prices, they're very close to being upside down on the house. So you have 35 million households, on average, that are near or into book insolvency. That tells you something about why the saving rate is starting to rise as people desperately try to cut back spending and get themselves situated, balanced. Explains why we got yesterday the first indications that our Americans are paying down debt for the first time in quite a number of years. The fourth problem I want to talk about is the lines crossing problem. Now, Maya didn't let me bring up PowerPoint, so let me just ask you to do this mental experiment with me, all right? I want you to imagine a graph. In fact, you can do it with me. I want you to take your left hand, and I want you to draw a line like this. Everybody, lift your left hand and draw a line. That's it. That's the line right here. This is total government revenues, and however you want to define it, these are total government revenues. And then I want you to take your four fingers here, and I want you know, these four fingers to go up like this. Here, the little one down here is interest on the debt. Okay, interest on the debt. This next one right here is Medicare. This next one right here is Social Security. And this one right here is tax expenditures. These four lines steadily rise, and according to last year's forecast, that lines crossing problem is 15 years out. But that assumed the Bush tax cuts would be repealed, and it assumed no major slowdown. We've got a major slowdown, and the Bush tax cuts are not going to be repealed. So, in essence, these lines are going to cross at an earlier point. What does it mean when we say these lines cross? What it means is There's no money to fund the Federal Aviation Administration that enables the FAA air controllers to enable your plane to land safely. It means there's no money for the federal court system. It means there's no money for Army, Navy, Marine Corps. It means there's no money for Head Start or Early Head Start or college scholarships or anything that you look at the government doing. Zero. Okay. What does that mean for now? When we look at the lines crossing, say it's going to cross in 12 years, it says the discretionary portion of the budget is contracting at a rate of in excess of 1.5% per month. It's contracting 6 or 7% per year. That means that every government program you think about, except the ones I mentioned, tax expenditures, Medicare, Social Security, interest on the debt, everything else has got to be thinking about being reduced over the next 60 months by 6 or 7%. The rest of the world is seeing this. I'm a managing director of a global asset management company. I travel all the world. I talk to Minister of Finance, Central Bank, as do others on this panel. And what we're hearing is they know the problem we have. The private investors in those countries are looking at the problem, and they're saying, hey, I understand you want to do this, you want to do that, but the reality is you haven't got any money. And the only money you get is the money we give you. And frankly, we're losing confidence. We're not going to give it to you. So we know that ideally we should be selling. Fifth, civil transition. This budget architecture that we have in the United States at the federal level and the state level defines relationships among Americans. It defines who gets what, who pays for what, and who owes what. The budget, as you know, is tremendously out of balance. So the relationship between Americans is tremendously out of balance. It's out of balance with respect to region of the country, it's out of balance with respect to line of business, it's out of balance with respect to income, and it's out of balance with respect to generation. Now generation is the one you hear all the time about, but the other three are big and very important in this. The relationship among Americans is going to be put into tremendous turmoil. The rest of the world sees this. They see that the civil relationships among Americans are going to be in conflict, and they understand that that conflict is going to contribute to increased uncertainty and reduced downward pressure on asset prices. Last point, time frame for stability. You will know when the U.S. has begun to bottom out or head up when you see A, restoration of foreign confidence in U.S. private assets, B, full adjustment, accommodation of the U.S. economy to higher food and energy prices. 3, you see stability in U.S. household finances. 4, you see something concrete done. You will see that the Committee for Responsible Federal Budget has actually finally succeeded, and our government is operating on a sustainable forward federal outlook. 5, in civil transition, you will see the, like we did in the S&L crisis in 1989, you will see the government accepting, public accepting, political system accepting the tax burden responsibility of dealing with the problem. And that time frame, if we use the S&L example as a time frame, the S&L problem started in 1981. It was solved effectively in 1989. So 7 or 8 years from now is not an unreasonable outlook for a point in time when you can say with confidence, we're now on the mend. Thank you.
Thank you, Tim.
Should have brought a puppet show to follow up on 5 little fingers. Extraordinarily erudite and expansive commentary. I'll make it very, very quick. We'll get to your questions. What's next? The pace of change in just the last 24 hours is so extraordinary, it's hard to know what the deadlines tomorrow brings. I agree with my counterparts up here that the Fed's ability to pay interest on reserves and expand its balance sheets will have a profound impact, which they will begin to put in place in the very near term. The decision yesterday to support the commercial paper market, $1.6 trillion commercial paper market, is extraordinary and will prove helpful. And I think we'll see that have an impact going forward as well. And then this morning's announcement of a global coordinated 50 basis point rate cut, I think, is also a much needed defibrillator for the markets, sort of a financial central bank shock and awe approach to trying to get ahead of market sentiment, which, as you know by reading the headlines and we know by talking to them, is quite negative. And I think we'll have more of those rate cuts coming in the very near term, probably not much more from the Fed, but certainly more from other central banks around the world, and hopefully more from the Europeans, which I think have found religion over the past 24 hours. Is it enough? Probably not. We'll probably see more. We'll probably see a fiscal stimulus package maybe as early as a lame duck session next month. I think what we'll see also is an attempt to take a bottoms-up approach and try to keep foreclosures at a minimum, keep people in their homes, and try to readjust mortgages that may, or depending on how it's done, it may or may not be expensive, but it will cost additional money. And I think that's what's been missing, actually. I think we should have taken a more bottoms-up approach rather than a tops-down approach, or at least complementary to a top-down approach. And I think that will be on the agenda, again, either for November or for February. Despite all that, we're still going to have deflation, we're still going to have deleveraging, we're still going to have shrinking balance sheets, both in the financial sector and households. And that means that we're going to have credit contraction. Credit, which was once cheap and abundant, is going to be expensive and almost non-existent unless you probably don't need it. We're going to see industry consolidation in the financial sector and a ripping out of the infrastructure of the financial service industry, which will prove important as we come out of this cycle at some point 4 or 8 quarters from now. The infrastructure that was in place to support the housing industry will be gone. And as the market at some point will stabilize and at some point rebound, we have to ask ourselves, where will be the mortgage market infrastructure to support that rebound? I suspect there won't be much of an infrastructure left. And then slowing global growth, which Mark talked about. We'll have a global recession. This silly notion of a decoupling from the U.S. has now been shown to be as absurd as it was. Somehow the rest of the world was just going to float along without the U.S. or without Europe. 40% of China's exports go to the U.S. and Europe. And I think, well, we've shown that, in fact, that we are interconnected, both in the real economy but also in the financial channels, and both those channels will have a real impact. And it will be at both the macro but the micro level. Emerging market corporates have been on a borrowing spree, just like everyone else. They've got to roll over about $200 billion worth of debt between now and the end of the year, and they probably won't be able to do so. We've already seen just in the last 24 hours a number of medium-sized corporates in Brazil and Mexico and other emerging markets declare bankruptcy because they simply don't have access to short-term credit. What worries me going forward, Imai and I had lunch last week, and I think we both depressed ourselves that we had dessert to help accommodate. And that is, we could see a period of regionalism where Asia and the Middle East turn inward and do so in a protectionist manner. There was a press release in just the last couple of days where East Asian countries were talking about putting together some sort of regional fund, an $80 billion regional fund, on top of what is known as the Chiang Mai Initiative, which is a swap facility for Asian countries, which grew out of the Asian financial crisis, and the response from the IMF, which was seen as very negative in the region, is still seen as negative. And what you could see in the Gulf and in Asia and other places is an inward turning effort to create a fortress Asia or a fortress Middle East or a fortress Europe. And what we'll see is a fractionalization of the global system that we've all become used to and taken for granted in the post-war era. Maybe protectionism. Think about all those countries that are derived their legitimacy by creating jobs, and not by elections, but just simply because of prosperity. As demand for the products they produce declines, do you think they're going to allow high unemployment? Probably not. That means production is going to continue. Where is that production going to end up? On global markets. What's it going to do to prices? It's going to drive it down. And you think about the response that's going to occur in this country, in Europe and others. It will be protectionist responses here and protectionist responses in other countries. And we could see a reinstatement of the beggar thy neighbor policies that we've witnessed at other points in history, and which led to fairly cataclysmic periods of warfare and strife. And we also could see failed states. Think about the number of countries, emerging markets, that 2 or 3 years ago were the darlings of the global financial markets that now are teetering on the brink of financial collapse. What does that mean for their populations? What does it mean for their governance, especially if they have nuclear weapons? I won't name any states. There's a real regulatory risk next year that Congress comes back and puts together a perp walk and goes after the Great Witch Hunt Act of 2009. Who are we going to throw in the volcano? We started with AIG yesterday and Lehman the day before, but it's going to be much worse. And if you think about Sarbanes-Oxley on steroids, that's what we're going to get. And that is going to have profound implications for how the industry goes forward. But the period of time between now and the time that law is signed in, that legislation signed into law, is going to be enormous uncertainty to what the industry looks like. And I don't know about any of you, but I'd be hesitant to put capital into an industry that I don't really know what it's going to look like or how it's going to be regulated going forward. But I know it's going to be regulated. In longer term, we may be sowing the seeds of the next asset bubble. We'll go through a deflationary period, but we're going to have an enormous accommodative fiscal and monetary policy globally. And is this simply putting in place a re-inflationary set of environments or policies that will create an inflationary environment that we're going to be back here in 36 months worrying about and the implications for that period of time? Last, let me say that there is a potential positive piece to all this, and that is for 30 years we've lived beyond our means, right? We've spent more than we've earned. And we bought a bunch of stuff that we really didn't need, and we jammed it into our houses that we couldn't afford to pay for. And maybe this is a period where we reconnect with what's real in life, right? I don't want to sound philosophical this morning, but maybe it's a period of time in which family and community and the environment and other aspects which we give a lot of lip service to but don't do much about, maybe that's a period of time in which those things become real in our lives and we spend more time and attention on them and less time buying stuff that we really don't need. Thank you.
Thank you so much to all of you for really what was a remarkable panel that exceeded my expectations and what we could have learned from such a great group. What I'd like to do is use my moderator's prerogative to throw out a couple of questions. I know you have all been watching the presidential and vice presidential debates, so you know how to answer the question you wish I had asked instead of the one that I do ask. So, in fact, feel free. What I think you could do is just comment on any of these questions or comment on something you heard from one of the other panelists, and then we'll open it up to folks in the audience. We have a really incredible group in the audience as well, a lot of expertise here. There are a couple people who still don't have chairs. I think there are 1 or 2 free chairs over there for those of you who tire standing, one right here. The 3 questions I have are the first one is about the appetite for U.S. Treasuries. We're going to have to borrow a whole lot, and you can see kind of different scenarios for playing out for how the global marketplace responds to the need to issue more Treasuries. I'm curious what people think will happen there. The second is something that both Dean and Tim talked a lot about, but this transformation from a borrowing and consumption society to more of a saving society. Good thing or bad thing? Certainly some of the answer has to do with the timing over which that happens, but how do you feel about that likely change? And finally, what do you think should happen next? Should we see a stimulus package? Should we see other movement from the Treasury, the Federal Reserve Board? I realize that is really dependent on the things that unfold in the following days, but if you have strong opinions about what you hope we'll see, that would be useful. And finally, of course, if you've heard anything from the other panelists you'd like to comment on, please feel free. Martin, could we start with you, please?
Rob Duggar and I have been friends for a while, but I can't resist. His remarks made me think about the movie When Harry Met Sally. And Billy Crystal is complaining about the breakup of his marriage and the infidelity of his wife. And his friend says, "Oh, infidelity is only a symptom," to which Billy Crystal replies, "That symptom's bopping my wife." I have altered the dialogue in deference to the C-SPAN audience. And it's true that in some sense the housing bubble was a symptom of broader economic forces, but it sure is doing a number on the economy right now. And I think it's a big part of what we're dealing with. I was very intrigued by Mark Zandi's support of the package, and I would look forward to hearing either in the panel here or offline exactly how this price discovery process will bring more capital into the banks, because I confess I don't understand that, and if that's what they're going to do, I really hope you're right, Mark, but I'd like to understand that a little more. Appetite for, I'm not sure I'm going to answer all your questions, appetite for U.S. Treasuries. That seems to be very high right now. We actually had the interest rate on bills go negative, I think, briefly for a while. So a crisis scenario in which people flee from the U.S., no capital comes in, and interest rates soar. Well, obviously, risky interest rates have soared, but risk-free interest rates have not. They're pretty low. So the appetite for treasuries seems pretty strong. I agree with some of the things Dean Baker said and that Rob said about the need to transform from a borrowing economy to more of a saving economy. I don't know if the U.S. is ever going to get to the point where it'll have a current account surplus. It would be nice, but I'm a bit doubtful we'll get there in any time soon. But I think it is essential that over time we reduce that current account deficit. We're sort of doing it the hard way now because we're in a recession, so consumption has fallen. We're in a recession earlier than the rest of the world, so that exports remain strong and imports are weak. Over the longer run, we've got to have the dollar down, as Dean said, but we've also got to adjust our saving investment balance so as to sort of ratify that adjustment of the dollar and transform us into at least a more solvent economy than we've been on. The stimulus package, well, I think we may be running out of ideas to support this economy, and I think a stimulus package is sort of what we know how to do. The one we had earlier this year was modestly effective. The forecasting firm Macro Advisors was one of the sort of most bullish on the stimulus package. They estimated that about 40 cents of every dollar would get spent in the short run. In the light of actually what happened, they adjusted that down to 30 cents on the dollar. So it clearly is not, it has not succeeded in boosting spending as much as we would like, but nevertheless, I think it's probably something we can do and we should do. I do worry about the long-run fiscal implications of more giveaways, but I think it's better to prop up the economy than it is to and try to sustain full employment than worry about that in the short run. We do have to certainly worry about that in the long run. So I would support certainly having another stimulus package ready to go and maybe rolling it out.
Okay, very good questions, but I'll try to get to those quickly. I agree actually with much of what was said here by the other panelists. I don't have to argue too much. One point I will say, I think that we are looking at more bad risks with in the financial market. Again, I think I agree more with Martin than with Mark here, that I think there is a lot more bad debt yet to show up. And just one of the points I'd make on this is we have an awful lot of people who are underwater right now. You have a lot of people who own homes in California that owe $500,000 on it, and the home is worth $300,000. And they might be paying the mortgage today, but keep in mind the median period of home ownership in this country is 5 years. So you have a lot of people that are going to be looking to bring that house to sale. They're going to get $300,000. They have to pay a realtor's commission, and then the bank is looking for $500,000. Well, you're looking at a short sale. You have a lot of short sales. No one's written that down yet. So there's a lot more, there's other sources of bad debt here too, but that's, part of the story that hasn't even, banks aren't even looking, well, they're looking at it, but they have certainly not written that down. The three questions, the demand for treasuries, again, what Martin was saying, I've been amazed, not just the short term, obviously, but even the 10-year, there doesn't seem to be fear there. We're looking at 3.6 on a 10-year treasury. I don't know what it is today, but, it's just remarkable that, it seems insatiable. I don't hold it, but. I don't have billions out there.
I wish I had all
the transformation from borrowing to saving, I think it is important to, and I don't disagree with the point about the dollar, but I reverse the chain of causation here. I think that, the high dollar made all these imports very cheap. It created a situation, just sort of straightforward accounting. If you have a high dollar, imports are cheaper, we're going to import more than we export, our exports are expensive, and then how do you sustain demand? Well, it has to either be through very low household savings or very low public savings, very large deficits, in other words, and we've had a combination of the two. So that, to my mind, the high dollar is the real villain in the story. And from the standpoint of the individual household, when you had your house going up 10, 15, 20% a year in value, it was hard to tell these people. I was trying, but it was hard to tell people, don't go out and spend, it's not going to stay there. But they're seeing they had a home that was $300,000 when they bought it 5 years ago, now it's $450,000, and everyone's telling them it's going to be $6. To me that was unbelievably irresponsible, but that's what the wise people were telling them. So it wasn't just that they were being spendthrifts. If that was true, if their house is going to be worth $600,000 in 2 years, why not take a vacation, buy it? Why wouldn't you do that? The problem was that this was a bubble and it wasn't going to stay there. But, you know, unfortunately, most people, including most of the experts that they were turning to, didn't recognize that. The last point in terms of stimulus, again, I think, you know, we have some obvious, you know, how do you do effective stimulus? I think the tax cuts were certainly better than nothing, but, you know, I would rather have seen that go to, you know, one, state and local governments, something we could still do very usefully, so I don't have to raise taxes, cut spending. But secondly, you know, we can start, you know, for better or worse, since we're all talking about a situation where we're going to have a long downturn, the argument about stimulus is, oh, well, by the time that takes effect, we'll be out of it. I don't think we have to worry about that yet. So we could talk about stimulus that could be done for more long-term projects, in particular, emphasizing points that have been made by other panel members. For green stimulus, let's give the money to state and local governments, to households, to businesses, to retrofit their buildings so they are energy efficient. So I think that could be a main focus where we could both boost demand in the short term and have a very good long-term effect. The last point I'll just make about the deficit, and I encourage people to read David Leonhardt's piece in the Times this morning. I have a love-hate relationship with this guy. I trash him every other day in my blog, but today I haven't got a chance to write. I'll write a great column about it, or a great piece on it. He said, you know, the issue is healthcare. And, you know, I remember when Tim Russert back in 2000 was Florida, Florida, Florida. I write healthcare, healthcare, healthcare. If we fix our healthcare system, our budget problems, we'll have problems, but we can deal with those. If we don't fix our healthcare system, it doesn't matter about our budget. We're totally nailed. So, you know, I just say it's healthcare. If we got our healthcare system under control, we could deal with the other issues.
And that will require a whole nother panel. Mark.
Well, you know, I'm in this kind of unusual and slightly uncomfortable position of being more optimistic than everyone. That is incredibly unusual for me. And maybe I should turn dark again to feel more comfortable. I actually think one of the most positive things that's happened in this mess and in this calamity over the past month is that global investors have remained resilient buyers. The dollar is strengthened, it's not eroded. They're buying treasuries. They're not panicking like everyone else seems to be. So I take great solace in that. Now, it may be that they don't know where else to go, and I'm sure that's part of it, but the fact that they're still here and we're ground zero for the problem, but yet they still trust the AAA credit of the United States. We are still the place you go when there's a problem, even if the problem is here. And I think that's something we should take a great deal of solace in. And I think that will be important for us going forward, because we will be issuing a lot of treasury bonds. I said $500 billion in deficit, but issuance is going to be measurably greater than that. It could be over $1 trillion in the current fiscal year in terms of actual treasury bond issuance, particularly if the Fed really starts stepping on the accelerator here. So we need that, and I think that's a reason for optimism. You know, I do think we're in this painful transition from dissaving to saving more. We've had 25 years of a declining saving rate because of lower interest rates and lower rates of inflation, and because of what's happened with respect to financial innovation in the financial markets. And we're at an inflection point with respect to that. I think every economist knew this was going to happen. Everyone hoped, though, that it would be in a more orderly way and occur over an extended period of time. It happened over, hopefully, 25 years as opposed to 25 days, which is what's happening. But I do want to point out that not all household balance sheets are in bad shape. And in fact, I think there's a very clear distinction between two different groups within our population. One group, their balance sheet is a complete mess, as you rightly described. But the other half of the population, the balance sheet is probably as good as it's ever been. If they have any debt, it's a fixed rate mortgage loan. They don't have credit card debt. They don't have auto loans. They don't have student loans. They had more assets than they used to have a few more assets, or at least worth more 4 weeks ago, but they're a significant positive net worth. And half the population with clean balance sheets account for well over 3/4 of the nation's spending. Now, that doesn't say we don't have a problem, and I clearly sympathize with it, but it's not pervasive darkness. I mean, there is a very large portion of the population that's in very good shape. And by the way, I don't know if I heard Tim just exactly right. corporate balance sheets, non-financial corporate balance sheets, are in good shape. They're in very good shape coming into this, and that's another reason for some optimism. What's next? Well, hopefully we get some stability in the next few days so that we don't have to see what's next in the next week. And we give the actions taken to date a little bit of time. I do believe that when the TARP reverse auction process is put into place, when the CP program is up and running, which should be shortly, when the Fed does expand out liquidity because of its newfound powers, because of the ability to provide interest rates on reserves, I actually think that's going to work some magic, and hopefully it'll work enough magic that it gives us a little bit of breathing room to think about what we should do in a more appropriate way. If we get into the next presidency and things aren't going as well as hoped for, I do think it would be time to now address the problem directly. And I think you're right. If you pull back the onion enough, it really is this current account recycling that's at the core of it. But it is manifested in the housing market, and that's sort of ground zero for our problem. So I do think we need to focus on that. There are a lot of things that one could do there still. I'll just throw out a couple ideas. One, you could have some kind of tax incentive to buy a home in 2009. Double the mortgage interest deduction for anyone who buys a home in 2009 and phase it out after 3-5 years. The present value of that would be, $5,000, $6,000, $7,000, which is enough real money. Again, for only people who buy in 2009, and that would stimulate demand to work off some of that excess inventory. Also, another, if the TARP plan in conjunction with the Hope for Homeowners doesn't lead to significant mortgage write-downs, which another very positive TARP is that it could facilitate that through the purchase of second liens, which is a significant impediment to loan modification. But let's assume that it doesn't work. If we get into next year, we need a bigger mortgage write-down plan, and there are a couple of really good ones out there. Sheila Baer's plan, I think, is worth dusting off again and really thinking about that. So I think we have many bullets left, many things we can do, but hopefully we don't need to use them. We've got a couple of weeks and see how these things work out.
My good question. Let me try to answer it this way. We have completed the mark-to-market phase of the credit contraction. This is the phase where all the prices are very visible on the screen. And mark-to-market companies that have had to mark-to-market have gone bankrupt. And the government's had to step in and stabilize them in many cases. We're now entering the non-mark-to-market phase of the credit contraction. This is the phase that affects communities and banks and businesses all across the country. California comes in and says it needs $7 billion. Massachusetts shows up, it needs $100 million. State after state, county after county, region after region, all across the country is now seeing the effects of retail sales declines, which is reducing sales tax income, and employment declines, which are affecting income from withholding. So we'll see the credit contraction moving out from the areas and showing up all over the country in surprising ways as we move away from the computer screens into the broad areas of the economy. The mark-to-market phase deals just with the current account surplus component of the contraction. Cut off the flows to private borrowers in the U.S., and you see the immediate effect on prices on screens. The non-transparent phase will reveal the effects of energy and food prices and fragile household finances. Those two effects will show up next year. We're not seeing those yet, really. They'll show up with huge power next year. The year after that, we will see the effects of the lines crossing problem as the budget and the government's ability to finance these restructurings involve increasingly tough choices. And on this, I want to come to Tim's closing comment, because Tim clarified something that is extremely important. What we see happening is awareness that this is not really a discussion that needs to take place among finance types or economists. All this discussion up here about this program or that program, that's not the issue. The issue is whose taxes are going up. What are we going to spend the scarce resources we've got on? We need to have a national agreement about this. Because if there is no national agreement, there is civil competition or civil conflict. We have to have agreement. What matters to us? Do kids matter? Do families matter? Does education matter? Does clean energy matter? Do we really want to go back to trying to pop up the housing industry one more time? It's one thing to keep people in their homes, so those kids are not being dragged from one house to another. It's another thing to, we can engage in public infrastructure spending. Let's build schools. There's lots that we can do that unifies the country, but we first have to have a set of understandings of what it is we all agree on that we're going to mutually sacrifice for, take responsibility for as we go forward. So that priority adjustment is stage 3 of this credit contraction. The first is the mark-to-market phase. You know all about that. The non-transparent phase, we're into it. The worst of it is next year and the year after. And the priority adjustment phase, where we deal with the subject of the Committee on Responsible Federal Budgeting, the questions of the lines crossing problem, and what our civil transition, what the national priorities are. Those 4 and 5, those are the problems of the year 2010, 2012. We are in a long process.
I don't worry about treasuries, but if we keep dumping them on the market at the pace we're dumping them, then we are going to worry about it someday. And we should use this financial crisis to get our fiscal house in order. Other countries have done it, Canada, Sweden, India. We should use this as a call to arms. What comes next? I think we'll get a stimulus package, whether it's spending or tax cuts. We can debate, but I think there is certainly a need for spending in this country on infrastructure and other things. I think it will happen. I think we will have some sort of mortgage markdown and try to keep foreclosures to a minimum. And lastly, I would advise the president, I would take the world's leaders and go back to Bretton Woods, New Hampshire, just as they did in 1946, and reaffirm our faith in multilateral institutions. If you don't like the institutions we have, then get rid of them and get new ones. But we need to work collectively to deal with collective problems, whether it's climate change or immigration or other issues. And we have got to move away from this go-it-alone strategy, whether it's here or somewhere else. And we've got to reaffirm our faith in open markets and the free flow of capital and the free flow of goods and the free flow of services. If we don't, we will find ourselves back into a period where others try to export, including ourselves, export our unemployment and export our excess capacity. And that is fraught with problems. History is replete with examples where that has led to terrible times, wars. And we need leadership. With leadership, anything is possible. Without it, nothing is possible. And right now, we don't have it, and we need it.
Thank you. At this point, I'd like to invite questions from the audience. And as a sign of a really poor moderator, we start to run out of time. So what I think I might do is take a couple of them, and then again, let our panel answer, sort of pick and choose. So Mark, if you want to go here, then Martin Obernower behind.
Jonathan Lindley, Federal Housing Finance Board, an almost extinct federal agency, worked for a Democratic board member there. I want to pick up on a theme that Rob Duggar raised, and that was the question of the bailout bill. And he said he supported directed equity investments as one piece of that program. Let me throw an idea out and I want you to comment on it, and I think it may address some of the issues Dean Baker did about the dialogue over the bailout. It was not helpful in this case. Why not just take half of the funds in this bailout bill, $750 million, set up a U.S. sovereign wealth fund, which would make equity investment, deferred stock, take warrants on the back end, and inject capital into needed companies. Secondly, why not hire Warren Buffett to come on and run it? He seems to know what he's doing in this particular area. Third, if Warren Buffett won't take the job, why don't we contract with the government of Abu Dhabi? They seem to know how to run a sovereign wealth fund. Talk a little more about what should be in the use of the funds here. I mentioned the sovereign wealth fund because it's very different from calling it a bailout. It suggests that there are some returns to the government that they can earn. And by the way, I think if you run this sovereign wealth fund and take financial assets and stay away from the hard assets, you could be in and out of this in 5 to 7 years. Secondary market will come along and you can sell those warrants and preferred stock and so forth.
Okay, so one question is about a different model for a sovereign wealth fund for the U.S. If you could go to Martin, okay, please. Second question.
I'm Mark Katz, National Association of State Workforce Agencies. Do you think there needs to be a bailout or some additional assistance for the states in light of what California and some of the other states have been asking for?
Okay, problem for states. And then Martin Obenauer right there, please.
My question has to do with tax policy, which was alluded to earlier. It seems to me that both presidential candidates and their parties are talking about tax policies which they would philosophically like to see happen without regard to what's really going on today, whether it's the repeal or continuation of the Bush tax cuts, middle-class tax cuts with offsetting increases or more than offsetting at the upper brackets, alternative minimum tax, et cetera, et cetera. Is there consensus among this panel or indeed among economists as to what the best tax policy, proper tax policy is in the light of this economic crisis?
Okay, 3 very interesting questions to choose from. Who would like to start? Go ahead, Rob. Martin, please.
No, don't stop. Very quickly, I think
Always.
I think the sovereign wealth fund, I think that's sort of the idea we're talking about, but a sovereign wealth fund implies that it's a long-run thing, and I don't think we want a long-run sovereign wealth fund. But otherwise, sure, let's get, I don't know if Warren Buffett's the right person, but we clearly need someone good to run it. Any stimulus package, I think, should provide some assistance for the states. We don't want states having to be forced to cut back. We don't necessarily want to reward the states that have the most budget mess, but I think we would want to provide some assistance to states. The tax policy question is too complicated, really, to answer in the time available. I agree with the sentiment in this panel that we are not really having the right debate about tax policy. We're not facing up to the need to adjust healthcare spending and raise the revenue for the amount that I think that the American people want in the way of overall spending.
Rob, did you want to weigh in?
I think we're...
I'll be quick. We might as well just go
down the line.
since I'm second. Okay, the sovereign wealth fund, yeah, I agree exactly with what Mark said. I mean, the question is, how do you do this politically? We want to get in, get out. Warren Buffett would be great. I held up his purchase as a model. You know, we'll invest in Goldman Sachs. We're not going to just hand them money for their bad assets. Ken Rogoff at Harvard, former chief economist of the IMF, actually made the argument that the reason that the banks aren't raising capital now is they think they'll get a better deal from the government. Very plausible story, might well be. The state governments, I agree exactly with what Martin said, short-term problem, we have to ensure they can get credit. They're going to have a cyclical problem, so that's a very good use of stimulus, so they don't have to cut spending and raise taxes right now. Tax policy, I agree, that is way more complicated, I'll deal with. Let me just make one final point. We have kind of a contradictory story here that everyone should be aware of. There's sort of 2 basic issues in economics, at least to my mind, being simple-minded. One is that you have the story where we don't have enough demand, the Great Depression. The other one is that we have too much demand and we're competing over resources. You can't really have both at the same time. I think we're in the first world right now. We might be in the second world down the road. I hope to actually be in the second world down the road. But the first problem is what's immediately on the agenda, and that's why I feel so confident saying we shouldn't have another Great Depression. We do know how to get out of that one.
Well, I'm hopeful that we don't have to make direct equity investments in financial institutions. I think that certainly complicates life immensely, particularly in the longer run. And I'm hopeful that the troubled asset relief program will be successful. So I think certainly it's worth starting to discuss and think about, and I hope that isn't the first step, or the first move that the Treasury makes. I don't think it's necessary, and I don't think that. I think the first thing is let's see if the reverse auctions work and it does the trick. But if that doesn't, then the most obvious next thing is an equity investment, and whether you want to call it a sovereign, what we do with sovereign wealth fund or not, effectively it is, right? I mean, It could be in the Treasury, it could be another, it doesn't really matter. Essentially it's a sovereign wealth fund, right? So it's just a matter of name. But I'm hopeful that we don't have to go down that path. I think that would be unhealthy. Second, in terms of additional state aid, I think it's a reasonable idea. It might be important. The Fed can essentially lend to anyone under the emergency power clause, and decided to lend to non-financial corporations through the CP market. Actually didn't lend, it's buying CP. So there may be a more creative way to help hard-pressed state governments than actually giving a grant or something to state governments, which would be sort of the traditional thing to do through a plain vanilla kind of stimulus program. Maybe there's a better way to do that. In terms of best tax policy, consensus, no chance. That's our problem. I mean, that is an enormous debate. I mean, obviously, Maya will put a panel together. Several, I'm sure.
Healthcare and taxes, we'll get it done.
Yeah.
I'm going to go back to Tim's comment, his closing comment in his first round of remarks. I think they're really the answer to all the questions that have been raised. We don't need a sovereign wealth fund because we don't have much wealth. We could say it's a sort of sovereign poverty fund. That might be a good name. But a better name is a sovereign priority fund. What is it that matters to us? We're like a family. We have older people, younger people, cousins, aunts, uncles, kids. What matters to us? We don't have enough money to pay for our son's ear operations so the ear infections don't deafen him, and pay for the flat screen TV. That's where we are. So we have to make a decision. Do we invest in the kid's health, or do we buy the flat screen TV? Well, for most of us, that's not an issue. Invest in the kid. No question about it. As a society, we have to come and decide on what's important to us. When we know what's important to us, it'll be easy to adjust tax policy. It'll be easy to know whether to invest in states or do investments into banks. What are banks lending on? We can adjust the terms in which lending takes place or investment takes place. It's easy to do the tax stuff. It's easy to do, much easier to do the tax stuff. It's much easier to do the investment decision, and it's certainly much easier if you know what's really important to you to deal with the tough questions around retirement and health care reform, health insurance reform.
My wife won't let me have a flat screen TV, so it's not a choice. I don't need money anyway. The Treasury asked for the ability to do direct injection, and it's a tool in Hank's toolbox. I think he'll use it. How extensively it's used remains to be seen, but I think we will see some direct injections. Help for the states, absolutely. They're going to need it. And on tax policy, I agree, it's complicated, but at some point we're going to have to raise revenues. People aren't going to like it. We need to think about how we're going to do it and do it in a way that achieves a whole host of societal objectives. And maybe we can marry it with a more robust environmental agenda and look at carbon tax or other ways in which we can address climate change, which I think is a very important issue.
That is all the time we have for this panel, and thank you so much for a truly excellent panel. We are very quickly going to switch into the budget panel, go directly to consequences of the economic situation. Certainly they will be large. All of this is complicated, of course, by the fact that it's an election year and that elections lend themselves to promises, of which we are seeing many this election. We have two candidates who've laid out budgets that would enlarge the deficit by hundreds of billions of dollars a year. And again, I direct you to the project that we're doing at the Pew Charitable Trust called U.S. Budget Watch at the website usbudgetwatch.org to learn more about the specifics of the different fiscal promises from both candidates. Given the deterioration in the budget, which was not in particularly good shape to begin with, a major question is how will the candidates adjust their priorities? And this, of course, is a question that's been asked repeatedly in debates, but they've done their best not to answer it thus far. So luckily, there's a wealth of wisdom for us on this panel. We hope that the panelists will be able to delve into how the new president will be able to govern, given the fiscal constraints, and what they might do, in fact, to galvanize the country around a new, more realistic fiscal agenda. So today, we have with us Leon Panetta, former Chief of Staff for President Clinton and Director of Office of Management and Budget, and co-chairman of the Committee for a Responsible Federal Budget. The Honorable Bill Frenzel, former representative from Minnesota, ranking member on the Budget Committee and co-chairman of the Committee for a Responsible Federal Budget. We have Rudy Penner, former director of the Congressional Budget Office and currently senior fellow at the Urban Institute. Alice Rivlin, former director of the Congressional Budget Office and the Office of Management and Budget, senior fellow at the Brookings Institution. And Dave Walker, former Comptroller General of the United States and president and CEO of the Peter G. Peterson Foundation, which is focusing on these issues. So as you can see, we have people who have been there, worked these issues, and really an incredible gathering of expertise on the budget and fiscal issues that are at hand, that were there before because of the budget, what we're facing, and are now more important than ever given what's going on in the economy. So thank you all very much for coming and joining us today. Leon Panetta, if you could begin, please.
Thank you. Thanks very much, Maya, and thank you, ladies and gentlemen, for participating in this forum. You are looking at probably an endangered species up here at the front table, those who cared about balancing the budget and reducing the deficit. I think it's becoming a very small group these days as we deal with the crises that face this country. I mean, I feel a little bit, I saw this movie over the weekend, but I feel a little bit like I walked into the Poseidon adventure, where, you know, the economic waves have literally turned our economy upside down, and we're trying to see if we can find our way back up to the surface. This is without question, you know, a very challenging time. It's going to be a huge challenge for the next president and the next Congress to try to confront these issues. They face what I think is a major decision as to whether or not they continue a kind of borrow and spend mentality that we've seen over the last 8 years. And as a result of that, I think this country will see a continuing slow decline in our standard of living and in our economic competitiveness. Or whether we make some very hard choices, very tough choices, that ultimately can make this country competitive and that can restore some semblance of discipline in terms of our budget. That's a very tough, big choice that faces the next president and the next Congress. The problem is that obviously these choices are made much more difficult by what's happening at the present time. In the recent past, you know, I think we always used to comment, I certainly used to comment about the challenges that faced Ronald Reagan when the stock market crashed in 1987, and the willingness to sit down and try to address the problem of deficit reduction in light of what had happened in the stock market. The fact that George Bush's father was willing to confront the deficit issue in the '90 budget agreement and make some very tough choices, again, to try to confront that issue. And what Bill Clinton did in his economic plan, which put in place a lot of the same tough choices with regards to both spending and revenues. The problem is that we are dealing with some very different challenges than what all of those presidents faced. The size of this problem is huge. You're looking at a record deficit now of about $483 billion, approaching $500 billion. And I would wager to say that when the new president enters the Oval Office, that you're likely to see a deficit approaching $700 billion, if not close to $1 trillion. So it's going to be a very huge deficit that confronts the next president. Secondly, you've got an economy that is likely to be in a recession. Estimates right now are that we're in a recession. Probably is going to be much more of a hard landing than anybody anticipated in terms of this recession. So you're going to have an economy that is going to be very weak, and the results of that are going to feed even more problems into the deficit and into the budget challenges that will face the next administration. Thirdly, you have now a federal government that is deeply involved in the private market. $700 billion bailout package puts the federal government squarely into the middle of the private sector. And the result of that is going to be that not only will the federal government be deeply involved in what happens with regards to not just the asset purchases, but also what happens on the private side. There are others that are probably going to seek additional bailouts. In addition to that, the states are going to come in and ask for additional loans of one kind or another, or bailouts of one kind or another. I mean, what happened as a result of the $700 billion rescue plan or bailout, whatever you want to call it, is that that door is now open. And you're going to see a lot of people trying to come through it for additional assistance of one kind or another in the middle of this crisis. So it's a very, I mean, at one point you could basically say the federal government has no business doing that and get away with that. It'd be very tough to do that because of what's happened over these last few weeks. And lastly, you've got a leadership situation where, you know, when we sat down with Ronald Reagan, when we sat down with George Bush, when we did the plan with Bill Clinton, there was at least a sense on the leadership on both the Democratic and Republican side that this was an issue that had to be confronted. And I'm not sure whether that will is there now on both the Democratic side or the Republican side. So from a leadership position, and leadership that has to be there if you're going to make these kinds of tough choices, we have been through a period of very great divide in this country. The parties have been extremely partisan over these last few years. And frankly, winning is more important than governing. And so the real question is whether or not the leadership of the country is going to be willing to confront the hard choices that are here. Now, you know, I understand the realities of the situation we're in. And you've got to, when you're trying to rescue a drowning person in the ocean, you're not going to ask the Coast Guard how they pay for the gas to come there and rescue people. So I understand how difficult it is to try to say, you know, we've got to, at the same time, try to discipline our budget and try to ask the question, how do we pay for all of this? In the short term, there's no question in my mind that the deficit situation is very likely to get worse. Just because of the economic situation and just because of the door that was open over these last few weeks. The real question is whether or not in the long term we are going to abandon any effort to try to establish some degree of discipline on the federal budget. That's really the fundamental question. I think in the short term, we know that the deficit is likely to go up. There'll be tremendous pressures to do that. How can you at least try to address the long-term situation? And let me just make a few recommendations. First of all, there is no question in my mind that both candidates are going to have to limit their initiatives dramatically. Both have made a great deal of promises. Our estimates are that you're looking at roughly adding somewhere in the vicinity of close to $400 billion to the deficit if all of their promises, in fact, are implemented. That's not going to happen. They're going to have to walk into the Oval Office, and the first thing they're going to have to do, they're not saying that now, but the reality is the first thing they're going to have to do is limit their initiatives. And most of their initiatives will not be able to be accomplished. Secondly, they've really got to focus on a 5-year strategy. This cannot be just a short-term approach to it. You've got to develop a 5-year strategy that sets a path for this country towards trying to restore some discipline, trying to ensure that we don't dig this hole any deeper. That's probably, the best we can hope for right now is to try to make sure this hole is not any deeper than it already is. Thirdly, I think there's no question that on that 5-year path, there has to be entitlement reforms that address the problems related in particular to Social Security and Medicare, but Medicaid as well. You're going to have to address those reforms in the long term. And lastly, you've got to the extent possible, implement some kind of pay-go approach that makes clear that if you have initiatives, if you do any kind of additional tax cuts, you've at least got to find a way to pay for that over that period of 5 years or more, so that there is at least some semblance of discipline in doing that. This is, as I said, these are going to be challenges, and probably the biggest challenge of all is the political side of it. You've got, as I said, a Congress that, after 8 years, we've increased defense spending now to the tune of almost $600 billion plus the money we've spent on the war. Now involved with a huge investment in terms of rescuing Wall Street. The Republicans, who will come in with probably an even smaller minority than they have now, my sense is that they'll be much more resistant to trying to cooperate on some of the big challenges that face this country. I know there's this sense that somehow there'll be an effort to try to find bipartisanship on most issues. I suspect that when you become a small minority, the likelihood is it's going to be much more difficult to cooperate, and the incentive will be to let the administration either sink or swim on its own. That partisanship is deep up on Capitol Hill, and that's going to be tough to deal with. So the real question is whether a new president can provide the leadership that is going to be needed to try to not only convince the country about the issues that are going to have to be met, but also convince the Congress that they're going to have to make some hard choices. This is a very difficult challenge that is going to face the next president and the next Congress, and the real question will be whether or not both the president and Congress are going to be willing to ask the American people to sacrifice to do what's necessary in order to see if we can reach the surface again of our economic welfare.
Thank you so much, Leon. Bill Renzel.
Thank you very much, Maya. Thanks to the sponsors of this event, the New America Committee for Responsible Federal Budget and the Pew Charitable Trust. We heard before Leon's excellent presentation from another panel who told us, who more fully described some of the economic consequences that they are foreseeing for the short-term future. And those are pretty unhappy consequences. We formed this panel at least partially around this U.S. Budget Watch promotion that the Committee for Responsible Federal Budgets put out called Promises, Promises, a Fiscal Voter Guide to the 2008 election. And whatever the candidates have said that goes into this analysis, and whatever the analysis said, has obviously become obsolete due to the changing conditions. The candidates, when they presented their economic visions to the public, started with a baseline that would leave them with about $150 billion deficit after 5 years. Of course, that assumed that tax cuts would wither away, and et cetera, and that AMT would continue to develop scads of revenue. Both of them expected to continue large tax cuts. And as a matter of fact, as this analysis looked it over, both Mr. McCain and Mr. Obama were going to be producing around $400 billion worth of deficits after 5 years. Now we, of course, see that we're going to have that in the year just ended. And one of the previous panelists, Leon, actually mentioned the T word, $1 trillion for a deficit in the near future sometimes, and I guess I would have to say it would not surprise me. One of the other things the presidential candidates are talking about were reductions in spending that nobody, probably including themselves, believes are going to happen. Mr. McCain talks about eliminating earmarks and freezing domestic discretionary spending, reducing the troops in Iraq with caution, unspecified cuts. You add those four categories up, and he has suddenly saved us $318 billion. Mr. Obama says he's going to reduce Medicare costs, close loopholes. He is going to reform government spending. He is going to phase out Iraq troop expenditures, and then he also has unspecified spending and his cuts. And his come to $341 billion. Obviously, those things are not going to happen in the economic environment in which we now find ourselves. Last night, the candidates were specifically asked in a number of different ways. One of them, how would you change your priorities? A second question was, what sacrifices are you going to ask of the American people? And it is, of course, the nature of presidential candidates to be cunningly evasive, but they offered no clues as to the answers to any of those questions, as if to say, we worked hard at presenting our economic programs. It'll give us a headache to have to make some changes. But clearly the changes are going to have to be made. The previous panel believed, as economists, that we're going to need another stimulus package soon after the first of the year. And as the rescue package of $700 billion continues apace, we hope, that will be added to the mix. The previous panel also talked about adding a spending dimension to the stimulus, which of late has centered around tax cuts, including grants to state and local governments, and perhaps infrastructure spending. Now, I think the normal routine around here is that when the Congress gets a hold of those things, we are off to the races. Because if your state got some, my state wants twice as much. And if your bridge goes to nowhere, I'll raise you a couple of nowheres. And besides which, I have a lot of school buildings I want built. And so as we look at the impact on the long-term fiscal condition of the United States, it looks pretty terrible as our revenues decline due to the economy, and our expenditures and tax cuts increase in our efforts to reduce the decline and turn the economy around. Where does this leave us? After last night, it leaves me with a sinking feeling in the pit of my stomach. We don't have a lot of plans. And that what's going to happen is we are going to go forward with the usual competition between the two branches, with perhaps in these whatever future rescue programs come forward, we are going to have competitive raises from the branches, one to the other. Leon mentioned that we would need presidential leadership. In that, I wholly concur. It is always the executive branch which is first jerked back to reality. The legislative branch has much longer to dream. There is a problem, however, that no matter how much leadership we have in this country, it takes a little bit of followership to make the leadership work. And our leadership at the moment is, at least in my mind, somewhat unknown. The programs presented do not look to me to be sterling examples of leadership. The followership, I think, is even more questionable. But we will have new faces in both of those branches for the future, and we will continue to badger them in the name of fiscal sobriety.
Well, thank you, Maya, and thank you for organizing this event. I too am struck by how the world has changed since the presidential campaign began so many dreary months ago. If you look back then, we were looking at a short-run budget situation that could be relatively easily handled, with deficits maybe less than 2% of the GDP. We saw no hint of recession. We certainly saw no hint of the financial storm that was going to hit us. Now, even before you start counting bailout costs, the prospects are for deficits around probably $600 billion or so this fiscal year and next, and then you have the bailout costs to them, and as Bill and Leon suggested, you could be talking about deficits in the $700 to $1 trillion range. And those deficits would certainly break the post-World War II record relative to GDP, maybe not by a long shot, but I think more important, they're extraordinarily large absolutely, and even more important, they're extraordinarily large relative to the public debt that's now in the hands of the public. You could see the debt in the hands of the public easily rising by 30% or so in the next 2 years. Now I know that some eminent economists say it's okay to run large deficits when the economy is weak, and they argue that, well, maybe you shouldn't count this debt associated with the bailout because we are taking other assets off the street when we're putting the government bonds on. But I still worry about who's going to buy all that government debt as we create it. Government debt has been our most successful export in recent years. Foreigners are buying a huge share of it. But I think foreigners are starting to get very nervous about it. So like Bill, I was somewhat disturbed to hear the previous panel think up all sorts of new ideas for additional spending, including assistance to states and purchases of equity and all sorts of other things. I can't help but believe that by the beginning of next year, when the future path of the public debt is better understood, it's going to be like a cold shower for those advocating either expansive spending plans or major tax cuts. Of course, the one problem that has remained with us is the long-run budget problem that Leon and Bill discussed. Indeed, the long-run budget problem is becoming a short-run budget problem very rapidly. As one who is desperate for long-run reforms, I'd like to be able to argue that the long-run problem played some role in creating this financial crisis. That would be a very tough argument to make intellectually, I think. However, when you put the long-run problem together with this short-run situation, I think it's very clear that the long-run budget pressures limit our options for getting out of this short-run problem, and will mean that it'll be extremely difficult to reduce whatever debt we're creating. Should the next president be lucky enough to serve 8 years, CBO projects that Social Security, Medicare, and Medicaid will be taking about 1.8% more of the GDP at the end of the 8 years than they are today. Now maybe that doesn't sound like much, but if you think of it being financed by tax increases, it's a 10% increase over the tax burdens that we're used to. And of course, both our presidential candidates are advocating net tax cuts. If, on the other hand, the growth in the three programs is financed by cutting other non-interest programs, it would take an across-the-board spending cut of about 20% from the baseline. And that, of course, is while both candidates are promising to increase various kinds of spending. So I would conclude that even if the short-run surge in the debt does not handcuff the next president, the long-run outlook most certainly will. On the other side, I think that this financial crisis provides the next president with a golden opportunity to get our fiscal house in order. I would suggest an immediate post-inauguration summit comparable to that in 1990. I think the events of the last few days show, as Bill suggested, that just because leaders agree to something doesn't mean you're going to have any followers to implement it. And therefore, there has to be a vigorous parallel effort to educate the public as to the nature of the problem and the implications of some of the options of dealing with it. And I really admire Dave Walker's role with his new foundation in trying to do just that. Because it's clear that our dysfunctional Congress is not going to act unless pressured by the voters. And there's been really not much to educate the voters up till now, and certainly the presidential campaign has not educated the voters as to the nature of these problems. But on the other hand, this is going to be really hard. I think it's harder than it was in 1990. They did not really, neither the 90 or 93 budget deals really dealt with the Social Security problem. They did some minor things to Medicare, but nothing very spectacular. And I think a whole new dimension has been added to the current problem, because I think there's a kind of catch-22 with regard to taxes. On the one hand, I cannot imagine a bipartisan deal that does not involve some sort of increase in the tax burden in the future. On the other hand, I can't imagine the American public tolerating much of a tax increase when they believe that the current tax system is so incredibly inefficient and inequitable. If you look at public opinion polling on taxes, an amazing proportion of the American people think the rich don't pay any taxes at all because they can use tax lawyers to exploit the complexity of the current system and essentially avoid taxes. And while those of us who look at the aggregate numbers know that that certainly isn't true, on average, there are just enough rich people who manage to do just what the public suspects to lend credence to that belief. So I don't see how in this mega summit I'm talking about we can avoid a debate about tax reform, and that even complicates the issues further. But I really think we should try and see the current crisis as an opportunity to do some really fundamental long-run things after we deal with the very short-run implications of it.
Thank you. The crisis has taken over the campaign as it has taken over everything. But like Rudy and others, I see it as a new opportunity for the candidates to generate some momentum around their campaigns and to demonstrate, each of them in their different ways, that they are the leader needed for this crisis, not only for the crisis, but for longer run solutions for the economy and the budget. I didn't think they did terribly well last night. They should have had a good answer to the first question, and it should have been here's what needs to be done in this short-run fiscal crisis. If I'd been designing an answer, I would say we have to do everything that we can to get credit flowing. That both candidates supported the Paulson plan. They should be lucid in explaining how important credit is to small businesses and to individuals, and they should say that this was a good thing, not a bailout for rich people, and that it will take a little while to work. I think they should recognize, point 2, that we are in a crisis of confidence, that it's a worldwide crisis of confidence, that we need to work with other governments and the Fed needs to work with other central banks on a coordinated plan. They could suggest what things need to be done, could be lowering interest rates, could be injecting capital directly into the banks. That, in my opinion, is not a substitute for buying troubled assets. We probably need to do both, and they could recognize that. And then point 3, they need to say what they're going to do to stimulate the economy. That certainly should include aid to states. It could include another rebate. And if this is going to be a longer, deeper recession, it certainly is a reason for improving our infrastructure, which everybody wants to do anyway. On the budget implications, I hear much confusion. This $1 trillion number has been bandied about, and I certainly agree we could, in the worst case, get to $1 trillion deficit. But it's been used in a different context, with people saying, if you add up the $700 billion and what we have lent to AIG and what the cost for Bear Stearns and so forth, we're almost at $1 trillion already. A few other things. That's really not right. It is adding apples and oranges, and we do have to recognize that those are different things. The bailout package, the Paulson plan, has an unknown cost. It will be scored like a loan. It's a contingent liability. It won't show up as $700 billion in spending, and that is appropriate. We don't know how much it's going to cost in the long run. We do know that not doing these things is going to be extraordinarily costly if we believe that, and I think most of us do, that standing idle would have a worldwide financial crash followed by a worldwide financial recession/depression. We better do everything we can immediately to avoid that, and I think that's sort of the point. In terms of adding new spending, it seems to me that the candidates and eventually the president should have 2 criteria. Either the spending should be clearly temporary, as in perhaps another rebate to stimulate the consumption, or it should be clearly something we need to do anyway. And I think infrastructure and improving education and quite a lot of other things fall in that category. Long-run improvement in the productivity of the economy, and here's a chance to accelerate that. But the big challenges for the longer run are still there. They have not gone away, and they won't. They can't be ignored or put off. And here is another chance for leadership, for the candidates to say, we recognize that the federal budget is on an unsustainable track, no matter what happens to right the economy in the short run. spending projections dominated by Medicare and Medicaid, but also influenced by Social Security, are going to carry us to much higher percentages of spending as a relation to the GDP than we ever had or could finance. And we've got to figure out what to do about that. Ironically, I think Social Security may be easier to fix in the current climate. A Social Security fix is not all that hard. What was holding it up was the dedication of one party to private accounts. That's not going to fly. in this atmosphere, nobody's going to turn their accounts over to Wall Street. That may mean that we can get a Social Security fix done. Medicare and Medicaid, much harder. They have to be part of the general health care solution, because the problem is not just the aging of the population. It's not even primarily that. It's that health care spending per person at all ages has been rising at an unsustainable rate. So they have to say that they recognize that, and it isn't just a what are you going to do about Medicare question. It is what are you going to do about the health system. The primary problem is not how you're going to cover the uninsured, but how you're going to get the rate of health care spending to moderate. And I think there are ways that one can do that. But an important opportunity is to use Medicare as a leader in making the health system more efficient by not paying for waste and not paying for ineffective procedures. But we also have to broaden coverage to the uninsured, and there are basically two plans on the table. One that Senator Obama is espousing, which builds on the employer-based system and fills in the cracks, and the other that Senator McCain is espousing, namely a kind of voucher approach. Give everybody a certain amount of money. He does it through tax credits, and they aren't large enough, but and let them buy their own insurance. That's a clear choice. The Obama approach is easier because it builds on something that most people have, but I think he may be making a mistake in trashing the taxation of employer-paid benefits. Because in the long run, that employer-based system is very favorable to upper income groups. And finally, there's taxes, as everybody said. We have to reform taxes or we can't move forward. Part of this gap between spending and taxation will have to be filled by increases in taxes over time. I'm not advocating either candidate say that right away, but they have to recognize it, and they have to start laying the ground for a more progressive income tax and, I think, a consumption tax. Thank you.
Thank you so much, Alice. David Walker, please.
I'll be brief so we can get to Q&A. We have a dysfunctional democracy. Washington is badly broken. We have had a failure of leadership on both ends of Pennsylvania Avenue, on both sides of the aisle. Leadership is about identifying problems and acting to avoid them. It's not leadership to be able to do what has to be done in the face of a crisis. That's not leadership. Leadership is to be ahead of the curve. That's reactionary. This is the Constitution of the United States. It's very obvious to me that a lot of people in Washington haven't read this anytime lately. And it's about time that every senior official, every elected official had to read it, take a test on it periodically, and pass it. And if they don't, get them out. Because there are things that have been going on lately that arguably are unconstitutional, and nobody has challenged it because they've been afraid to challenge it. You know, we should be having a wake-up call right now, and I want to look at it as half full rather than half empty. The factors that resulted in the current crisis exist with regard to the federal government's finances. A disconnect between who benefits from current policies and practices and who pays the price and bears the burden. a lack of transparency with regard to the nature and extent and magnitude of the real risk, and therefore uncertainty with regard to what the real situation is, and emotions take over. Thirdly, too much leverage, not enough focus on cash flow, and over-reliance on credit rating agencies. And fourthly, a failure, and let me understand that, a failure of both corporate and government risk management mechanisms and oversight and regulatory mechanisms to act in the clear face of warning signals until we had a crisis before us. Now, those same four factors exist for the federal government's finances. There's only two differences. The magnitude, we're talking 55 trillion plus in a hole, the federal government. 55 trillion plus. And secondly, nobody's going to bail out America. We're going to have to solve our own problem. People have not learned. You got people lining up at the trough. Government doesn't have any money. We don't have any money. And what's going on right now is massive taxation without representation. Today's taxpayers benefit from low tax, high spend policies. We're mortgaging the future of the country, our kids and our grandkids. We're expecting for them to pay for it in generations unborn, and they don't have a vote. And that's not just fiscally irresponsible, that's morally reprehensible. And it's time that the American people sent our quote-unquote leaders a message. And frankly, I've been very disappointed for the most part with what I've heard from the major presidential candidates. For the most part. Although we did get some good questions last night at least. Didn't necessarily get good answers, but at least we're starting to get some questions. And maybe we'll get more for the last debate. You know, the simple fact of the matter is that we need to do whatever is necessary to deal with the current crisis. And we don't know how it's going to be implemented, this new authority. And that's really critical. And without knowing that, you have a lot more uncertainty and volatility in the markets. At the same point in time, we need to be able to handle two things at once. The next administration is not only going to have to reconsider all their promises because they're irresponsible, they're also going to have to focus on what is it going to take to get our economy on the right track in the short term, and they need to appoint a fiscal future commission comprised of capable people from both the executive legislative branch and outside of government who can make recommendations for an up or down vote on at least four things. Statutory budget controls, because Washington's been out of control since they expired in 2002. Comprehensive Social Security reform, it's easy. Round one of tax reform, including which ones of the Bush tax cuts are going to stay, which ones are going to go, what are we going to do about AMT, and how we're going to better target tax preferences. And round one of healthcare reform, including what can we do to reduce the rate of increase in healthcare costs, what can we do to better target taxpayer subsidies, and a variety of other issues, and to try to start reaching a consensus on comprehensive healthcare reform. We desperately need that. We need to do what it takes in the short term, but we need to start taking steps to diffuse what otherwise would be a super subprime crisis, and that's a meltdown of the federal government's finances. We cannot expect to be able to borrow wherever we want, as long as we want, for low interest rates from foreign lenders. And it's time that Washington wakes up. And you know what? The press has got a big part to help them wake up. You got a big part to help them wake up. And the stakes are very big. I'm very concerned about the future of this country and my kids and grandkids. And we got to start letting these presidential candidates, we got to hold them up, hold them accountable, and we'll see whether or not we're going to get some real leadership, because that's what we need right now.
Thank you. I feel terrible. It's yet another incredible panel, and I'm proud to say that all of the folks on this panel are members of the Committee for a Responsible Federal Budget, and they squeezed out all the fiscal optimism that we could find in this situation. You know, when I look at this, there are a number of sort of worrisome signs. One, when we look at what the candidates have promised out there, we already see that they have promises that would add hundreds of billions of dollars to the budget deficit. And that, in our analysis, we generously gave them credit for all of the savings that they said they would realize. And as some people mentioned, that's sort of much wishful thinking as it is likely. And second, when we saw what happened in Congress, we were able to pass a bill that arguably needed to be passed. But when Congress had a moment to breathe and to sort of think through this a little bit more, one thing that we saw happen was that in the Senate, the bill got larded up with irrelevant things. We had tax cuts. We had that were unpaid for, kind of as a way to circumvent the process. We had pork. So what worries me is the political process at a time of real urgency being able to face the leadership challenge that we have here. 2 questions for the panel, and again, please feel free to answer whatever question you wish I had asked. One question is, how does a President Obama or a President McCain come into the White House and do the right thing? This is one area where I actually see a little bit of optimism. I happen to believe that we have 2 candidates who both would like to, who both value fiscal responsibility, and that it's the political realities that push them to making promises that are unaffordable more than that they think this stuff doesn't matter. But many of you have been through this. When they go into the White House, what do they do? The numbers are about to be so daunting. Is it too much? Is it overwhelming? Should they focus on a short-term budget deal? Should they focus on something like Alice mentioned, focusing on Social Security first? Is a commission the right way to go? Something that Dave Walker has argued for very, very strongly and persuasively. So that's one question. My other question is, we have an immense amount of technical expertise on this panel, and I'm curious if any of you would like to shed light on this interesting role we suddenly have at CBO. We're going to have to score the bill that's just passed Congress. We're probably going to have a situation where the deficit numbers look very different than what we're adding to the debt, and that is a responsibility that would be very challenging. I wonder if any of you have ideas about how to move on that. Dave, you wanted to weigh in
Well, the
first?
leading indicator is going to be the financial statements of the United States government. I mean, the budget's largely a cash flow document. The financial statements are an accrual-based document. Now, the bill passed after the end of the fiscal year, and so they don't have to account for it in the year ended September 30, 2008. They have to disclose it, and we'll have to see what kind of disclosures we get. Those financials are due by December 15th of this year. It's true, as Alice said, that there are assets that are going to be acquired with some of these funds. They've got several options of what to do with the money. One is to acquire troubled assets, one is to give capital infusions, one of which is to create an insurance program. Who knows what else may be out there that may be an option. But to the extent that they acquire assets, that has some value. Now, one of the challenges is going to be is, how do you value it? And how do you value it in a way to make sure the taxpayers are getting a decent deal? That's going to be a major challenge, okay? But if they can go about that in a reasonable way, there will be some recovery at some point in time. However, keep in mind, we have no money, and we're already running deficits. So whatever money we're going to need to acquire assets, whatever else, we're going to have to borrow from China, Japan, OPEC nations, because we have no money. And so I think that clearly the debt is going to go up. I think it's very likely that by the end of this presidency, total debt of the United States will come close to doubling in 8 years. Total debt.
On both questions, first, I agree with David. I mean, I think one way or another, no matter how you ultimately score this, people are going to look at the debt and what's being added to the debt. And the problem you have is that we are trying to deal with one exploding bubble by creating another bubble, a debt bubble, that ultimately could explode on us as well. And I think that's the danger we're in right now. And so one way or another, I think we will know how deep that hole is, regardless of the various accounting rules that are used either by CBO or OMB. On the issue of presidents doing the right thing and facing it, Alice will remember this, but when Bill Clinton was first elected, there was, at that time, we thought we were looking at a deficit that was somewhere, around $250 billion, approaching $300 billion. And then when we went into the Oval Office, we realized the deficit was even higher than anticipated. And as always, the president, runs a campaign, makes a lot of promises, has a lot of hopes and dreams about the kind of legacy that president will provide for the country. And suddenly, when you face that kind of very real problem, you have to begin to to limit yourself, because that's the reality. And Bill Clinton had to do the same thing. Bill Clinton had to make a fundamental decision at that point. All right, you know, do I take on the deficit challenge with all of the ugliness that's part of that and the hard decisions you have to make on spending and revenues? And at the same time, can I, within that budget, try to develop some priorities as to where I could spend money? And he did. I mean, as we developed a tough budget, we still had funding for education, for research and development, and for some of the healthcare programs that he cared about. So we were able to develop some priorities. I think the next president pretty much has to go through that same process. The reality is the president's going to suddenly face this huge deficit walking into the Oval Office, which is going to be much worse than what I'm sure most of his staff or anybody else are telling either of the candidates at this point. And at that point, he's going to have to face a decision about whether you try to do the right thing for the country, which is to try to get a handle on this, with all of the tough decisions involved, trying to protect some of the priorities you care about, and try to put this country back on the right path. I think the next president has a tremendous opportunity. Everybody's mentioned this, but I do think that in crisis you have the opportunity to go to the American people and be very straight with the American people about the depth of the challenge we're facing and what steps need to be taken to deal with it. The American people are not stupid. They understand that ultimately they're going to have to sacrifice to try to deal with what is a very serious situation. The real question is whether the leadership of this country, the President and Congress, are going to have the honesty to tell them exactly what the situation is. If they have that honesty, if they're direct with them, then I think, in fact, there is a lot of hope that you can begin to take the steps necessary to get this country back on the right track.
I agree with all of that, but I think this president will be facing a very much more difficult situation than Leon and I and our colleagues faced in '93, because it's going to be a recession. We had a recession, but we were beginning to recover from it. We thought we needed a stimulus package. We did put one together, rather, that didn't find favor in the Congress, and it turned out not to be necessary. But this president is going to need a large stimulus package, I think. His problem, if it is Obama, is going to be fending off his own folks. It's a lot harder to deal with your own party in Congress than with the opposite party, because you know, they're your guys and you don't want to say no. But two more points since Maya raised them. I do think this is an opportunity to push Social Security reform as a way of gaining confidence that we can do something about some of these long-run issues, because that is an easy one. We could get it done. We could cross it off the list. And then move on to the harder problem of health care. I'm not a fan of a grand design, a commission that puts everything together and says yes or no. I don't think they could do that. Commissions work well when there is a consensus on what to do. I think you could do it on Social Security, as we did in '83. I don't think you could get a grand design on how do we deal with the whole long-run problem and vote it up or down. It's just too hard.
If I can jump on that, Social Security is very easy. There's already a conceptual agreement among a broad-based range of stakeholders about what to do on Social Security. We ought to be able to get that no matter who the next president is, as long as they're willing to stand up and go about it the right way with the right kind of process. Because process does matter in this town, in addition to what your policy proposal is. We can't wait anymore to do one thing at a time. Our fiscal clock is ticking and time's working against us. We need to start to be able to make progress on multiple fronts at once. And while I have some concerns about, whether or not a typical commission would work, in fact, I don't think a typical commission would, I think a commission comprised of the right people, where everything's on the table, with the right scope, that goes outside of Washington, that holds hearings, that listens to the people, that helps to educate people as to where we are, where we're headed, need for tough choices, benefits of timely action versus not, that gives enough moving parts that you can have political trade-offs to come up with a deal that can be voted on by the supermajority of the commission members with limited amendments with restrictions to keep you from being able to gut it, and with an up or down vote. You know, it's time we start holding people accountable in this town. You know, we've had a lot of lagship. We haven't had much leadership. Lagship is when you got a crisis and you got to do something. Well, that's not leadership. Leadership is where you have vision, where you identify that you've got large known and growing problems, where you're ahead of the curve, and you start getting things done before you have a crisis. We need leadership, not lagship.
In addition to some of the things that the other panel members have suggested, I have a few thoughts on what the President does to, in your words, do the right thing. I think the first thing he has to do is pick himself a cabinet that is a little different, but competent. I think, I don't mean that's different. The second thing he has to do is face up to the problem and define it and articulate it in his inaugural address, along with at least some beginning ideas of how to face the problem. Then I think he has to produce an honest budget. Now that is very much contrary to tradition in Washington, but someday somebody will try it, and we'll all be really indebted to them. Presidents normally like to predict rosy scenarios and high revenues and controlled expenditures, and they never work out that way. The next thing is, I think David's commission is a good idea, despite Alice's misgiving. Of course, it has to have the base closing aspect or the trade promotion authority aspect of being subjected to an up or down vote by the Congress. But I think it's worthy of a try. Maybe it goes in pieces. Maybe it goes in the whole big cosmic solution. But I think he ought to do it. He also ought to begin his term with a very determined outreach. Both of them have practically sprained their tongues telling us how bipartisan they are and how they reach across the aisle to everything that is wearing a different colored shirt. Things change when you get in the White House. And the problem is that no president, however skilled or determined that he is in outreach, is going to be able to collar the whole of the opposition party. And they need to take a page out of President Reagan's book. If he got one Democrat, that was a bipartisan bill. Rostenkowski refined it further by figuring if he bought one Republican, he had a bipartisan bill. And you don't have to get them all, but you have to get some. You at least need the coloration of bipartisanship. So that's the way the president has to get started. The second question with respect to CBO scoring brings to mind one of the Committee for Responsible Federal Budgets long-time goals of Concept Commission to tell us how we handle our budget, how we make our forecasts, how we score things. We're working off Rudy, last Concept Commission in the 60s, maybe. Things have changed. Budgets have changed. All sorts of things have changed. CBO will do its darndest, but Alice has already pointed out the difficulty of trying to figure out what happens to that $700 billion. And when we get it back, we may get it all back. We don't know. We may get none of it back. Well, we'll get some of it back, but we may get very little of it back. And so we don't know that. But one of the things the president could do would be to work on the budget concept along and integrate into that the reforms that Leon was talking about for process reforms, including a really solid pay-go provision. And then I think he'll be making a good start.
Well, I'm really afraid that the next president will be very strongly tempted just to try and muddle through. And indeed, that could work probably for 4 years. Although I think the real problem with that, of course, is what we've already discussed with our huge dependence on international capital markets. But the more persuasive reason he should not do that is that he really will be handcuffed. I cannot see significant major initiatives in infrastructure, education, or even health without starting to deal with this long-run problem. If he can be persuaded to deal with it, then the first problem is figuring out how to explain the problem. We economists are not very good at that, I'm afraid, but hopefully he can get the best PR advice possible to learn how to put it. And then I would very much agree with Bill that this has to be a bipartisan kind of solution. Even if the Democrats gain enormously in the Congress, even if they get 60 votes in the Senate, one party just cannot force through a solution, because that solution won't be stable then in the long run. And Bill talked about appointing a somewhat different cabinet. I think the next president would be well advised to appoint people from the opposite party to key posts, much as John Kennedy appointed Douglas Dillon to be Secretary of the Treasury. On the CBO scoring problem, boy, am I glad I don't have to do it. It really is impossible at this point to put a number on it, because this bill gives the Secretary of the Treasury broad authority to buy all sorts of things, including my house if I can sell it to him. And so you really have no basis on which to make a judgment until you start to see how he actually starts to use this money. Even then, it'll be enormously difficult. But I am glad that we are instructed to use the scoring procedures of the Credit Reform Act of 1990. I think that's a reasonable way to do it. It will maybe confuse people, however, because the addition to the budget deficit will be so much smaller than the addition to the public debt. And I hope that people can sort of understand why that came about.
Thank you. I'd like to open it to questions from the audience. And just if you could wait for the microphone and identify yourself. Bruce Bartlett.
Bruce Bartlett. I don't think this may sound surprising. There's not nearly a sufficient sense of urgency in this discussion. And the reason is that we're going to have an election in 3 weeks, and the very next day, the transition will begin. People from, more than likely, the Obama campaign are going to start flooding throughout all the agencies, and the ones who get to OMB are going to discover that the budget for next year is already largely written, and so they will do what every new president has done since 1981, to prepare like an alternative budget that will be presented sometime after Inauguration Day that will specify changes to the existing budget. And this is the absolute critical opportunity to do all the things that need to be done. And the important thing here, and I would love some insight from Leon and from Alice about how to impress upon Obama that he needs to get this out of the way fast in his honeymoon period, when there's an absolute sense of crisis that will allow some things to be done that would otherwise be absolutely impossible politically, on the tax side, on the entitlement side, and how will it be possible to talk him out of doing what his natural instincts are probably going to be, which is, let's get over the crisis first, let's do some stimulus, and we'll get to this later. And I would point out, having been a veteran of the George H.W. Bush administration, that that's terrible advice, because if he waits 2 years, as George H.W. Bush did, to do his budget deal in 1990, only 2 years away from an election, he's going to get beat. Now, the other problem that I would love some input on from former members of Congress is that how is Congress going to be talked into doing a budget deal in early 2009 when the evidence from 1993 is you lose control of Congress the next time. So this is the enormous problem we have to deal with. The right thing for Obama is to get this stuff get the pain over with fast. 4 years from then, people will forget it. Things will be better. He'll win re-election, but he's going to lose his party in the mid-year elections. So how can these? It seems to me are the critical questions that need to be asked. And just one final suggestion. It seems to me that there's been way too much talk in budget circles about this looming problem and oh, woe is us. But it's here now, and I think that an enormously useful thing would be to put together a transition-like commission of budget wonks to start writing actual legislation that can be plugged into this crisis atmosphere where the CBO does this kind of stuff, has been doing it for years, but just get away from these vague generalities about problems and start talking about actual changes in the law. What are we going to actually do to Medicare that will actually reduce its expenditures, and put a bunch of proposals out there, all of which we can come up with fairly easily, and just try to have a menu of things that could be given to the next president where they have something to start from. So that's my comment.
I know there's a question in there somewhere.
What do you think about that?
I don't think there's any question in my mind, certainly, that a new president has to hit the ground running. And you do have a honeymoon period. You do have, I think, people sense that, with a new president, new administration, there is inherently some hope that that president will address the issues and that things will get better. There's no question there will be pressure on the president to address the immediate problems in the economy, and there'll be a lot of pressure from the Congress. If Congress can enact a stimulus in the lame duck, which I don't expect they can do, they'll make an effort at it. But if they don't, then there'll be tremendous pressure by a Democratic Congress to do something on a stimulus early next year, if not sooner. Well, that's after the president's inaugurated. And so that'll be on the front burner. If I were the new president, what I would do is not simply proceed with a stimulus program on its own without bringing the leadership of the Congress to agree that if a stimulus is done, and one probably does need to be done, that it has to be done in the context of their agreeing to the larger budget issues that have to be presented to the country, and that he's got to bring them in to understand that the budget he's going to present is going to involve some very hard choices with regards to spending and with regards to priorities and with regards to what should be done on the entitlements. And Congress has to buy into that whole package, but that should be done early on, even before he's inaugurated. If you can get that kind of cooperation on the larger picture, then you have half a chance of trying to get something done. If you don't, then there'll be the likelihood is that you'll do a stimulus. Then there'll be an effort to do some other spending programs, because everybody will be trying to get their favorite spending involved in trying to bail out the country. It'll be very hard to hold that back. And when you come in then with a very tough budget, it'll be tough to get Congress to support that. So if you're going to do it up front, get their agreement up front, and try to ensure that you at least have their cooperation in putting that first budget together, which in many ways will define whether or not the next president is a success or not.
I'm enormously attracted to Bruce's idea, but let's think about it. I think you could do the short run and a credible 5-year budget. You could put in the Social Security fix. I think there's enough consensus on that, so you could bring that out right away and say, let's do it. I don't think Medicare can be reformed without figuring out how to reform the whole health system, because the problem is the pervasive rise of pervasive growth in per capita spending. I don't think there's a consensus in the country on what to do about that, let alone in the Congress. So I think the president has to put it out there, say he may do the commission thing on medical care. He's got to get across that he's really concerned about it, but I don't think it's practical to put legislation in the first budget.
I agree with Bruce that the next president, whoever that might be, needs to take advantage of the current crisis. It needs to rally the country, not just to deal with our current situation, but to provide leadership so that we can start dealing with a much bigger problem that frankly, people have been sitting on too long. I do think that we need to have comprehensive health care reform, but I think it's imperative that we make some changes to Medicare and our tax preferences for health care ASAP. We can't wait for comprehensive health care reform for that. There's plenty of things that can be done to reduce the rate of increase in health care costs, to better target taxpayer subsidies, to better target taxpayer preferences without having comprehensive health care reform, and we need to do that because that's the one thing that could bankrupt America. I think the next president needs to send signals very early on about what were the principles and priorities of their administration be. And those principles and priorities have to be, where will they invest and will they not invest, both with regard to direct spending as well as tax preferences. OMB, I think, should be particularly important in this next administration. Tough choices are going to have to be made on the budget side. A lot of major management reforms, I'm talking about major reforms, are going to need to start moving out, with regard to government. And I think OMB is also going to be able to have to deal with the Defense Department. Most administrations, OMB has not really dealt that much with the Defense Department. And the Defense Department does a great job in fighting and winning wars. They waste tens of billions of dollars a year, every year. And something's got to be done about that too. But we can't leave the tax side off of this. You've got to keep in mind, this country spends $3 trillion a year out the front door and $1 trillion a year out the back door. Those are called tax preferences, deductions, exemptions, exclusions, credits. That's real money. And we have to put that on the radar screen too and subject that to the same degree of scrutiny that we are direct spending programs, because there's a lot of waste there. There's a lot of inefficiency and ineffectiveness there. We got to put it all on the table.
Let's turn to another question. Right here.
Thanks. Gary Mitchell from the Mitchell Report. I want to ask a question that deals with two subjects that we've been talking about today. The first is leadership and the second is followership. On the subject of leadership, in the two times in our history that arguably come close to matching this, the elections of 1932 and 1860, the president-elects in both cases chose not to sort of join hand with the sitting presidents to work out solutions. They both decided that it was in their leadership interest to let Buchanan finish his term and Hoover finish his term and then jump in and take the leadership reins. My first question is that the model that the 44th president, the president-elect, ought to be thinking about, or is it time to think about a new one? And the second was on followership, and it's a really simple question, and that is that the emergency room is no place to lecture about the need for holistic and integrative medicine. But one of the questions that I'm wondering about is somewhere in this fix, it comes back to David Walker's sort of waiving the Constitution. Do we want to give some thought to the importance of what I'll call civic education, which is really focused on upgrading the literacy of the country around governmental and economic issues?
Can I start, since it kind of relates to our mission? First, I think the president needs to pull together and identify his cabinet quickly. It needs to be a coalition cabinet. People talk about bipartisanship. Don't forget that a plurality of Americans are political independents, and an increasing political plurality of Americans are political independents, and so don't forget about independence too, okay? Competency. I think both candidates, frankly, would be well served to make it fairly clear pretty quickly who they're looking to for some of the key, positions in this time of crisis, if you will. But even if they don't do anything in advance of the election, they need to do it quickly afterwards. At the same point in time, the president is the president until noon of January 20th, 2009, and therefore I think you want to be able to demonstrate you're getting off to a fast start, you're trying to pull a lot of things done. That doesn't necessarily mean that you're usurping the rights of the current president. You're preparing to be able to get off to a fast start. I think with regard to our financial challenge, for example, we have a macro problem, and that is the federal government doesn't know how to manage its finances, and frankly, too many Americans don't know how to manage their finances. They're following the bad example of federal government. We also have a dysfunctional democracy, and we have a dysfunctional civic engagement system. So one of the things we're trying to do in the Peterson Foundation is to deal with both, to try to deal with the macro problem and the micro. And the micro is to try to support efforts, through public education, on financial literacy and civic responsibility. Because I would argue, until you deal with the micro problem, you're not going to solve the macro problem. Because after all, the first three words of the Constitution are the most important, and that starts with the people.
I'd like to comment with respect to how the new president works with the old president. I believe the model, the 1860 and the 1932 model is the best with a certain amount of variation. I don't think presidents can work together primarily in this election. Perhaps the one constant in this 18-month election cycle has been the unpopularity of President Bush. And I think the new president risks, if he does things hand in hand with an old unpopular president, putting the taint of an administration which is not highly regarded, although it's 3 times better regarded than the Congress. So I would suggest that, they obviously have to meet. There has to be a waxing of the Obama star and a waning of the Bush star if Obama is elected, as it looks like it is going to be. And Bush has to be willing to step back into the shadows a bit as Obama begins to pick cabinet and articulate a new position. My guess is that he would be perfectly willing to do that. And so I'd suggest that's the way it's going to have to work. With respect to education, I think that is absolutely essential. I served in elective office for a long time, and my constituents were firmly convinced that we could rid ourselves of all deficit if we could cut welfare, foreign aid, and my salary in inverse order. Obviously, there is no understanding of either the short-term, the immediate problem, or the long-term problem. David is working on that assiduously, as all of us are, but it's a complex course, and perhaps not rocket science, but it's not very attractive to most of the constituents, but we have to do a better job.
We have time for one final question. We're going to go right here.
Hi, I'm Dick Miller with Federal Funds Information for States. Doesn't this housing crisis provide us with the unique opportunity to put the healthcare spending crisis in the same context? They're both bubbles. The public understands bubbles now. The housing bubble is a 10-year bubble. The healthcare bubble is a 30-year bubble. The healthcare bubble is still inflating. I work with states, and even the state in the war situation right now is building medical schools, is building health research facilities as economic development projects, because they've been told that's where the money is going to be. We have to this is a unique opportunity to put that in the same context as the housing bubble, because the public knows what the housing bubble has done to us.
I'm going to expand and allow for one more question back here from budget expert Ed Lorenzen. Wait for the microphone.
Ed Lorenzen, the House Majority Leader. The first panel talked about the need for an economic stimulus, but recognized the long-term problems. And this panel talked about the need to deal with long-term problems, recognize the need for stimulus. My question is, how close are we to having those two collide? And what I mean by that is, how close are we to the tipping point at which the amount of borrowing for short-term stimulus would end up having a negative effect, more of a negative effect, because of the problems with foreign capital inflows as well as the interest costs that will be associated with that with borrowing. And so how do we find that balance, and where is that line in terms of providing additional fiscal stimulus, but without borrowing so much that we cause near-term and long-term fiscal economic problems?
Excellent question. Oh, sorry. I was just going to say kind of a reminder why we want the U.S. to keep a fiscal balance sheet that's healthy for times like this. So each of you are free to comment, and then also this will be closing comments. Rudy.
Well, that's exactly the point I was trying to make in my prepared remarks, that there is this collision. I think the problem of the growth of the public debt over the next couple of years is so huge that, in my judgment, it really should rule out any notion of a short-run stimulus package.
I'm less convinced of that. I think that we do need a short-run stimulus package. It is very nervous-making, and we don't know where this line is. We have borrowed a lot. But I think if we let our economy fall into depression, we are in even worse trouble. So we have to take the chance that we can borrow some more and get out of this recession. But I want to come to the other question, if I may, about, I wish I thought that the health care increase in spending was a bubble. I'm afraid it is not. It is partly because we don't deliver health care very efficiently, but it is mostly because health care has gotten more effective over the years. There are more things doctors can do for us, and we all want that. It is not, bubbles suggest it might just go away. It won't go away. Healthcare costs per capita are going to go on rising. We have to figure out as a nation how we keep them from eating up everything else. But unfortunately, I don't think it's a bubble.
I think we have to put things in perspective, okay? First, not all economic stimulus plans are of equal merit and have equal impact. So it really depends to a great extent on what's the size, what's the nature of it, and what is the likely impact likely to be. Now, if you look at it from a materiality standpoint, we're in a $56 trillion hole. We're borrowing a lot of money. We're going to pass a tipping point, I think, within the next 5 years or so under our current path. Nobody knows for sure when that'll be, and that's not me, that's Paul Volcker, former Federal Reserve Chairman, okay? So, you know, when it's going to be, I don't know. But here's one of my frustrations. Look at all the time and effort we spent dealing with this current crisis management situation. And the net cost of this is going to be undetermined. Let's say it's $500 billion. Okay, let's say we get money back, and it might even be less than that. Who knows? All right, depends on how it's executed. That's less than 1% of our federal financial hold. Less than 1%. And look at all the hassle we had to get that, and we're doing nothing about the other. So we may have to do something intelligent that's targeted, that's temporary, to try to do short-term stimulus, in recognizing to get back on the path. But my question is, when are we going to start dealing with the bigger problem, which frankly has all the same warning signs as the other one? And, you know, frankly, you're not talking recession if it blows, you're talking depression.
Hey, you know, the problem with the stimulus plan is that it satisfies a political need more than an economic need. Because people who are elected want to convey the impression that they're doing something about a situation in the economy that obviously is in trouble. And so there's always this need to try to look like you're doing something. I mean, one could argue that the last stimulus plan didn't do a hell of a lot of good in terms of ultimately avoiding the problems that we were facing. So there'll be a political effort to try to say to the country, and part of it is psychological, which is to say to the country, look, you know, we're trying to help you in some way. We're trying to do something to try to help the country. I don't know whether, you know, what a stimulus, everybody has their own idea as to what a stimulus plan ought to look like, whether it's infrastructure spending, whether it's this, whether it's handing out rebates. I mean, there's a whole series of ideas out there, all of which, you know, I have some concerns about as to whether or not they really work or don't work. I do think there's probably a need to do something on workman's comp. I think there probably is a need to do something to try to see if you can stimulate job production in the economy. But I don't know what specifically those answers are. I do know that if you allow the stimulus horse out of the stable, that it's going to be very hard to deal with the bigger issue in terms of the long-term budget. That's why I think if a new president is going to address this issue, he's got to do it not only with regards to what kind of stimulus we ought to put in place, but it has to be part and parcel of the debate about what the long-run budget looks like. If you don't do that, then you're really going to lose any discipline whatsoever in terms of the bigger picture that you're going to have to address at some point.
I believe that with respect to the long-term, short-term collision, that the new president has to act, and he has to apply the leadership that restrains the Congress from doing what its inclinations will be, which will be to add earmarks until a pack of earmarks becomes a boondoggle, and the boondoggle becomes an obscene rescue package. And he's going to have to do that either before or during the lame duck session, which is going to be very difficult. The other part of it is there are a few hardy souls up in the Congress who understand the need for fiscal discipline. And you're working for one of them, so we depend on you very strongly to carry that out. With respect to the healthcare bubble, I must confess that I find myself with Alice. I really don't consider that a bubble, has some of the aspects, but I think it's quite a different problem.
So, on behalf of the Committee for a Responsible Federal Budget, thank you so much for joining us today. I think all the answers for what's next can be found in this panel and the previous one. Thanks for coming.